Good evening, everyone. So, I think yesterday we discussed money multiplier effect, CDR also, and we had to continue from monetary policy. Any questions from previous class? No questions.
On the chart, like it was like GVA factor cost plus production cost, net production taxes equals to GVA base price. Actually, when I studied earlier, it was something different. Like I was little bit confused. Like GDP at market price.
Okay.
Does it directly equate with GVA at factor cost plus production and something? So I will ask her.
Okay, yeah. After the class, we'll see about that. Any other questions? No other questions. So we'll start with monetary policy. Foreign donation. GNP is, what exactly are we calculating in GDP, GNP, all these things? What should the number show? It should show value addition in the economy, production in the economy. Donation is not production. Donation means money has just transferred from one person to another person. We want to calculate production. Because it is difficult to calculate production, we are calculating money exchange that goes in the opposite direction. All the money exchange that happens without any production is not added into GDP, GNP, NDP, NNP, none of this. Any transfer payment that happens just from one person to another person is not going to be added because there is no actual value addition that happens in these transfer payments. So now coming to monetary policy. Usually it is decided bi-monthly at present. Bi-monthly means once in 2 months, but whenever RBI wants in the middle, it can actually change this monetary policy also. It is like an aeroplane is in autopilot. Whenever the pilot wants, he can come back to it and immediately take control. Just because it is said that it is decided bi-monthly does not mean RBI has no power in the middle to change it. It can change whenever it wants. Now coming to repo rate. Earlier we have seen that RBI controls credit, and through credit it controls inflation in the country. How does he do it? RBI gives loans to banks. Banks will give loan to people. By this, we are able to control how much money is present in the economy. Repo rate is the rate at which RBI gives loans to banks. And what is kept as collateral in repo rate is government securities. What is the meaning of government securities? Bonds issued by government. That means government has taken a loan by issuing this government security, and banks have this already. Now, banks will take this and keep it as collateral with RBI and bring a loan. In repo rate, who is giving the loan? RBI. Who is taking the loan? Is bank. What is the interest rate called? It is repo rate. Currently it is 6.5%. What is collateral? Government securities. This is the only meaning of repo rate. Repo rate, full form of repo is repurchase obligation. Repurchase obligation means it is almost as if they sold the government securities with an obligation to repurchase it back, and that is why it is called as repo. It is both are same. Whether they kept it as collateral and later brought it back by paying back loan, or they sold it with a repurchase obligation, both logically are same. Repurchase means what? Buying it back. You sold it to someone, later you say that 1 month later I will buy it back from you. It is same as taking a loan, keeping it as collateral. Next, reverse repo rate. In reverse repo rate, it is the exact opposite here. That means banks are actually giving the loan to RBI. In this case, you can see RBI gave loans to the bank. Bank gives loans to RBI and the interest rate is called as reverse repo rate. RBI will keep government securities as collateral with banks. That means it is the exact opposite. Who is giving the loan in reverse repo rate? Banks. Who is taking the loan? Is RBI. Interest rate is called as reverse repo rate. What is collateral? Government securities. So this is basically, why does RBI take a loan? Does it need any money? No. Then what is the reason? To control liquidity in the economy. If RBI is taking loan, money is going towards RBI. That means less money is going towards economy. That means we are able to control inflation. When does it control inflation? When reverse repo rate increases. That means banks have more incentive to give loans to RBI because they will get more money, more interest if they give to RBI. If more money flows towards RBI, then less money is available in the economy. What happens to inflation? Inflation reduces. Then when repo rate increases, then you can say they will take less loans from RBI because the interest rate is the loan is costly, interest rate is high. Banks will take less loans from RBI, banks will give less loans to people, and that means liquidity reduces. Then what happens to inflation? reduces. That means you can see both repo rate and reverse repo rate. When we increase it, inflation will reduce. That means what is the effect of inflation? What is the relationship between inflation and repo and reverse repo rate? It is inverse relation. Can we say, imagine there is a statement, repo rate and reverse repo rate have the same effect on inflation. Is it true or false? It is true, because you can see when we increase either of them, it will reduce inflation. When we reduce either of them, it will increase inflation. You understood this? Next, coming to open market operations. Use of repo and reverse repo rates to manage liquidity, you can say, is together called open market. Here, what does RBI do? In the medium to long term, it will, you can say, sell and buy government securities. Medium to long term means here we are not talking about years together. That is called long term repo. Here we are talking about only 1 month, 3 months. In banking, or you can say in money market, short term means 24 hours, 7 days, 14 days is short term. Medium term is up to 1 month, and long term is up to 3 months. This is how money market works, because every day money is getting exchanged.
Sir,
yeah.
Is the repurchase obligation still there in the open market operations?
It is still there. Reverse repo is, you can say, not being used, but repo is still there. That means reverse repo, we will see they have replaced it with SDF, which is a new mechanism that they have introduced. Repo is still present. So here, what do? Using repo, reverse repo operations, they will control the liquidity in the bank, and this is why it is called, you can say, open market operation. Selling and buying of, you can say, government securities is happening. This open market operations, they are doing it to control, you can say, liquidity in the bank. Means if the bank wants to give more money to people, it can take this, you can say, under open market operation, RBI will give loan to bank, and this money will be given to as loan to people, because 3 months time is decent enough for the bank to later pay it back by, you can say, new deposits that come or new old loans that are being paid back. This is the objective here. Open market operations can control inflation. This is true or false? Open market operations is repo and reverse repo only. Using that, we are controlling how much loans the bank is giving, and that means it is true. There is another way to use same repo and reverse repo operations. This is short term, that means day to day. Only day to day means if you take a loan from RBI today, within 24 hours you have to pay back this loan. Using this, it is slightly difficult to control inflation. Then why do we have this whole liquidity adjustment facility? Yesterday we saw the whole banking system is resting upon the trust of depositors. That means if depositors' trust is lost, the entire banking system will collapse. This is what happened to Silicon Valley Bank. So in this case, imagine depositor one day comes and asks the money back. In this case, this bank does not have any money. It will try other mechanisms, but is unable to get it. Then it will go to RBI, and under LAF, it will bring a repo rate loan and pay back the money to the depositor. So this LAF is just, you can say, trying to adjust the liquidity to make sure that we pay back the depositor, so that the trust of the depositor in the banking system will remain as it is. So the objective here using LAF is not exactly to control inflation. It is, you can say, to control the mismatch of liquidity in the banks in the short term on a day-to-day basis. Mismatch of liquidity means the bank is unable to pay back the depositor. In this case, RBI will give this loan so that depositor is paid back. Here, the instrument is still same. That means the instruments in this actually liquidity adjustment facility are repo rate, reverse repo rate itself. Another case, why do they use reverse repo rate then? Imagine some depositors who have come today and huge amount of deposits have come into the bank. Imagine 1,000 crores of deposits have come. But today how much loans, if you see how much loan they have given, it is only 100 crores. The remaining 900 crores in the deposits of the bank, are they assets or liabilities to the bank? They are liabilities, because why? They have to pay to the depositors interest, and that means this bank will face losses if they don't give loan to anybody. Imagine nobody else is taking loan. They can give it to RBI under reverse repo rate just for 1 day, 2 days or something. You understood this? So this is how they will try to adjust this mismatch of liquidity within the bank when very short term periods, that means 24 hours, 48 hours and such. This is called as liquidity adjustment facility. The difference between open market operation and liquidity adjustment facility is only in its time period and intention behind why we are using them. But the instruments of both are same, repo rate and reverse repo rate. Instead of reverse repo rate, SDF has replaced it. This part we will see later, but as of now there is not much difference. You can think of it as reverse repo rate itself. The instruments are, imagine a knife can be used to cut vegetables or stab someone also. That means the instrument can be same, but you can use it for different purposes. Same thing here, repo rate, reverse repo rate, the instruments are same, but we are using it for different ends here. That means the goal is different. RBI has also created long-term repo operations. Here also actually repo rate is still same. 2 to 3 year 10-year repo loan is given, that means it is very long term. We are talking about for money market, this is the longest term that we have seen. 2 to 3 year 10-year repo loan helps increase liquidity with banks. That means earlier what used to happen was the banks used to take a short term loan, but they were insecure about what if we are unable to pay back. So that means they were not giving much loans. They were just investing in government securities or something which we can sell easily and pay back the RBI. But now because RBI is giving longer term loans, banks feel more comfortable, they give more loans to people. And so this helps increase liquidity and it reduces interest rate. If more banks are all trying to give more loans to people, what happens to supply of loans? Supply of loans in the economy will increase. Demand of loans are same and supply of loans increases. What happens to interest rates? It will reduce. Loan market is similar to tomato market itself. If supply of tomatoes increase and demand is same, what happens to price of tomatoes? It will reduce because supply has increased, not enough buyers are present and the prices will reduce. Here the price for a loan is basically its interest rate. You understood this? So this is long term repo. Same repo, reverse repo you can see has been used in 3 different manner, 3 different types. Long term repo is one type. Look at this question. If RBI purchases government securities via open market operations, RBI is actually purchasing it. That means what happens to liquidity? RBI is purchasing means government securities are going towards RBI. Where is the money going? This is government security. This is the RBI. Money is going towards economy. It will go to bank and then from there it will go to economy. If liquidity in the economy, what is the question? Liquidity. Liquidity, if they are not given anything, we have to assume that they are asking about the economy. You understand? Then it means what is the answer? It is going to increase. You understand? So in entire monetary policy, the role is logic is very simple. If money is going towards RBI, liquidity is going to decrease. If money is coming towards economy, liquidity is going to increase. You understood this? So whenever you are confused, you draw this sort of you can say some sort of map, you will be able to identify it whether actually money is going out or money is going in. Monetary policy corridor, will come to this monetary policy corridor and SDF later after we see other mechanisms. So next, money at call and short notice. In this case, basically we saw that depositors have deposited money and other people are taking it as loans. When depositor asks money back, if the bank does not have money, first you can say RBI is not the first resort. We already saw RBI as lender of last resort. First they will try to take a loan from other banks. Imagine this is bank B. There are other banks also, bank A, bank C. They will go to other banks because other banks are able to give a loan at a lower interest, whereas RBI is giving loan at a higher interest. This bank market between these banks where they are giving loans to each other, this is called as call money market and notice money market. Call money market means loans are given and taken between banks for 24-hour time period. Notice money market means same between banks for 7 days and 14 days. Only the time period is different. Call money and notice money means you can see money at call or money at short notice, both are same. The name is slightly different. So between all these banks, at what rate they are actually given and taking loans, if you try to take some sort of an average, some type of measure out of it, then imagine one day you measure it and the average amount of interest rate from between these loans is very high. What does it tell us if interest rates for loans are high? What does it tell us if the prices of tomatoes are high? Demand is more than supply, and that is what it tells us here. Demand for liquidity, demand for cash is more in this market compared to supply. That means you can see the interest rate between these banks has increased. And if it has reduced, then demand is less. That means more cash is present, supply is more than demand. That is why interest rate between these banks has reduced. You understood this? So to measure the average of all these things, that means some sort of a mechanism is used to consider and calculate what is the average of, you can say, all the banks' interest rates that they are giving on a daily basis. That is what we call as MIBOR, Mumbai Interbank Offer Rate. Interbank means between banks, offer means they are offering loans to each other. That is Mumbai Interbank of Mumbai is the financial capital of India. Mumbai Interbank Offer Rate. Earlier, LIBOR was already present, we have just replicated in India. LIBOR is London Interbank Offer Rate, which is London used to be the financial capital of the world. At that time they created this LIBOR. So we have replicated the same thing in Mumbai in India. By looking at MIBOR, what can we tell? We can tell the liquidity between banks whether it is high or it is low. You understood this? Liquidity means availability of cash between banks, if it is high or if it is low. We can tell by looking at this MIBOR. MIBOR is, like I said, the average of whatever loans on a daily basis it will get updated. Today what was the interest rate between banks. RBI can observe this, what is the MIBOR, and then RBI can decide what to do, whether we should, you can say, do some selling of securities or buying of securities or something. MIBOR is an indicator, it is not an instrument. Instrument and indicator, what is the difference? Instrument means you can do something about it immediately. Like for example, an accelerator, a clutch, these are instruments. Indicator means in your dashboard fuel is empty or something else, seat belt is not on, this type of things are you can't press it. It is only indicating to you which says that you have to do something else. You understand? And this is a MIBOR is an indicator. It is not an repo rate is an instrument. And so repo rate is like in front of your pilot there is some sort of a lever or something. This is how repo rate works. So then coming to bank rate. Bank rate is very simple. RBI gives loans to banks without any collateral. Because if the collateral is not there, then the interest rate will be high or low? High. It will be high. So it is very simple. Who is giving loan is RBI. Who is taking loan is bank. There is no collateral and interest rate is called bank rate. It is the highest among all monetary policy rates is bank rate. So rate at which RBI provides loans to banks, there is no collateral required here. So it is not used as primary instrument by RBI anymore. Earlier they used to pledge government securities, commercial bills or something, but now they have changed the rule. There is no need to pledge anything. That means without any collateral they will give the loan, and it is not being used by RBI as primary instrument. Right now the primary instrument of monetary policy is repo rate. So as of now repo rate is a primary instrument, means we will try to use repo rate to you can say do any changes in monetary policy. That is the first resort. Interest is relatively high, so banks don't usually prefer it. So repo rate bank rate difference I have given, it is same. You can say it is very simple. Repo rate has collateral, there is no collateral here. Short term, longer term. Bank rate is usually, you can say longer term, 6 months up to 8 months, 9 months also will be present. Repo rate is always lower. Then repo rate is not used as penalty. Usually bank rate, because it is the highest rate, we use it to decide how much penalty has to be paid by bank if they are not keeping rules, if they are not following the rules of RBI. That means imagine they are not holding CRR or SLR or something. How much penalty they have to pay? We will link it with repo rate. I mean bank rate. Bank rate plus 3%, bank rate plus 4% or something is decided. How much penalty you have to pay? Normally if you can say jump the red signal, there is 500 penalty or something, that is fixed. But for banks it is not fixed, it is based upon interest rate. Bank rate plus X% if you don't hold CRR. You understood this? So that is penalty rate. Penalty rate is a different function, it is not used as interest rate there. They are just trying to decide how much penalty has to be paid by bank. Imagine bank has to hold CRR as 4% but is only holding 3%. On the remaining 1%, imagine 1% here is 10 crore. On 10 crore, they have to pay, you can say bank rate is as of now some, what is the bank rate currently? 6.75 plus imagine 3.25%, and that means totally 10% they have to pay on this 10 crore. That means 1 crore as penalty. This is how they will calculate how much penalty has to be paid. So then primary instrument of RBI in controlling inflation is repo rate. It is not, a bank rate is not. Banks prefer repo rate as far as possible. Why do banks prefer repo rate? Because interest rate is low, that is why they are preferring repo rate. I mean, yeah. So next is CRR. CRR normally is at 4% usually. Right now we have increased it to 4.5%. What does it tell us? If yesterday we already saw what is money multiplier effect, how CRR impacts money multiplier. If we increase the CRR, what happens in the economy? Money supply will reduce. How much money has been created in the economy will reduce. Why have we increased it? Usually CRR will change money supply drastically, and still we have increased. It means that we are in some sort of an emergency type of situation where inflation is not reducing by normal mechanisms. What is the normal mechanism we are talking about? Repo rate. Repo rate is not working as it should. That is why we have increased this, because for 3 consecutive quarters we already saw that inflation has breached this 6%, which means that normal situation it is not normal situation. That is why we have increased this CRR. CRR is an extreme measure. It can be used to control inflation, but usually it is not done. Only in 10% of the times it is used, because when we are not able to control it using other mechanisms, we will use it. It is like the emergency button in front of pilot, red button, whatever is there, that type of a type, you can say, instrument. If CRR is changed, it means that we know that we are not in a normal situation. You understood this? CRR during COVID we had reduced it to 3% because demand had reduced it to such an extent and we want to reinvigorate the economy. Reducing the CRR is like giving some sort of shock to the economy so that it will come alive again. It's almost dead, and now we are trying to give some sort of a shock so that sudden money supply will increase. So CRR, how is it calculated? Imagine for simplicity, let us consider it to be 4%, which is normally the case. It will be calculated based on NDTL. Yesterday we discussed what is NDTL, net demand and time liabilities. That means total demand and time liabilities minus loans given to other banks. But we don't calculate it, you can say, we calculate it as an average of 15 days. Fortnightly average we take it. One day if it is 3%, another it is 5%, it don't matter. No penalty will be there. At the end of 15-day average, it should be 4%. Imagine 15-day average is not 4%. Then they will decide penalty based on bank rate plus X% and that much penalty has to be paid to RBI. RBI does not pay any interest on it. The cash is kept with RBI. CRR is kept with RBI. SLR is kept with the banks themselves. So this part you can remember. CRR is kept with RBI means the cash is actually kept inside RBI. RBI does not pay any interest on it. If RBI is not paying any interest on it, will the bank make a loss or not? Yes, but still they have to keep it in RBI. So RBI says, see, you try to recover this loss by charging higher interest rate on remaining 96% of money which you give as loans. So they will try to increase the interest rate on others. Look at this question. In which of the following bank will not be making any money? Meeting CRR requirement, will it make any money? No. This is 1. So it will not be making any money. This part is true. So this part is true means 1 should be there or not. If 1 should be there, which one can you eliminate? B can be eliminated. Then meeting SLR requirement. SLR we have not seen yet, but SLR probably you already know. That means SLR means they will hold it in what form? Mostly cash or government securities, or it is possible for them to earn money on this or not. By holding government securities it is possible. That means meeting SLR requirement it cannot be correct. That means 2 should not be there. Then which one can you eliminate? D can be eliminated. Parking money in RBI under reverse repo. Will they earn money or not? Yes. They will earn reverse repo rate. So 3 cannot be there. So answer is only 1. Now coming to SLR. SLR means as banking system grew and became bigger, RBI realized that only CRR or these existing mechanisms are not enough to make sure the depositors will get their money back. Because on a daily basis, probably you can say millions of depositors in tens of lakhs, they used to ask their money back, and sometimes it so happens that the bank will not have enough money to give to everybody. And even if you don't give a few depositors, this creates a crisis of confidence on the banking system. That means people will lose trust on the banking system. Okay. Usually my speed is generally fast, but this class I thought I'll go a little even more faster. Okay, I'll go a little slower, but so I'm teaching under the assumption that you already know this and this is like a revision, but it's fine. You can tell me if you are not able to understand. I'll you can say paste to that whatever level you are able to get it. So right now I'll slow down a bit. You can tell me if that is fine, then I'll continue with that pace. So if you did not understand any of these things so far, you can ask. You understood these topics, whatever we have discussed until here. So, or any point if you did not understand, you can ask. Because ultimately, for me it won't make difference. For you, I thought we have to go fast because prelims is approaching. So actually those of you who attended my classes already, this is revision for them. Those of you who are new, maybe my approach is slightly different. So you will be maybe able to not be able to understand it. It is fine for me. It won't. I mean, even if I take extra 1 or 2 classes, it won't make any difference to me. For you, if it is fine, then we will go at a slower pace. You tell me which part you did not understand, then I will repeat that part. Is it fine? Everybody is clear. Which one?
In the bank rate, penalty rate.
Okay, penalty rate. So usually how penalty rate is calculated? Imagine you do any violation normally, you jump the red signal or you don't wear mask, there used to be penalty or something. Here it is an event that happened. That means you don't wear the mask, then you have a 200 rupee penalty or something. But when bank does a violation, imagine we do that. Imagine you are not holding 4% CRR, so there is a penalty. If you do this, so what is the penalty? Imagine they will randomly declare 1 crore penalty or something. Then the bank will feel, if I violate CRR by 1 rupee also there is 1 crore. If I violate CRR by entire 100 crores also there is 1 crore fine. Then what will they do? Will they violate more or not? To prevent this, there has to be proportional punishment to their violation. How to ensure proportional punishment? We have to measure how much has been violated. Imagine 4% CRR. Instead of 4%, they have kept only 3%. In case they have kept only 3%, there is 1% violation. 1% imagine is 10 crores. On that 10 crore, there will be penalty in the form of bank rate as of now is 6.75% plus some 4% or 5% extra they will add, and that much the bank has to pay penalty. Imagine the violation will increase to 20 crores, then the penalty will increase or not. By doing this, what is the advantage? We can ensure that the penalty is proportional to the violation. If they violate only 100 rupees of CRR, then the penalty is also less. If they violate 100 crores of CRR, then the penalty is also more. We have added a sense of proportion to the punishment, and that is basically the objective of using bank rate to decide what is the penalty. You understood? In this case, we are not using bank rate as interest rate. We are just using to decide how much penalty has to be paid. Everybody is clear with this? So, any other questions? If you did not understand any of the topics which we have discussed so far, you can ask. Everybody is clear? So, next coming to SLR. SLR has to be kept at 18% because whatever as the banks became bigger and bigger, when depositors came and asked back the money, this 4% CRR also it can be used to give back depositors, and similarly CRR cash whatever is kept with RBI, or they can take a loan from other banks. So far everybody is clear about how depositors' confidence is protected. So far we saw the measures where depositor comes and asks the money back. This bank can approach other banks and take a loan and give him back, or it can go to RBI. It has many options. One is repo rate, one is bank rate. It can bring this loan. There is another option using CRR also it can pay back this person's money. So that means all these are options available to the bank to pay back this depositor, so that depositor's confidence in the banking system is upheld. So right now we felt that these measures are not enough because the bank's size became big, and many people on a given day, how many people are asking for money, it is varying. On one fine day, huge amount of people may ask for money, and this amount of money, 4%, all these measures are not enough. So we created another measure called as SLR. SLR is statutory liquidity ratio. Statutory means what? We have introduced it into law. CRR and SLR have statutory status. They have been introduced into law itself. So that is why it is called, you can say, statutory. Liquidity means, everybody knows the concept of liquidity. Liquidity, in literal terms, you can consider liquidity to be equal to cash, first thing. Second thing, if it is not cash, then ability to convert something into cash. Cash has highest liquidity because you can convert cash into anything else. So converting X to Y is actual concept of liquidity, because cash can be converted anything else into else, easily. That is why cash has 100% liquidity. So the concept of liquidity can also be considered as how easily you can convert something to cash. You understood? Because once you convert it into cash, cash can be converted into anything else. This is the concept of liquidity. For example, liquidity of cash is 100%. Liquidity of gold may be 90%. If you go and say, I will eat pani puri and will give gold, the person is, you can say, somewhat puzzled because they don't know whether it is actually real gold or copper or bronze or something. That means liquidity is not 100%. Here you need verification and such. If you say, I will give my land for pani puri, then liquidity is only 50%. That means they will probably not accept it. It will take a year by the time you convert that land into cash. You understood? Liquidity is your ability to convert X to Y, and cash has 100% liquidity. That means you have to keep in statutory liquidity ratio, you have to keep something which you can convert easily into cash, or you can keep cash itself which has 100% liquidity. So RBI gave three options for the banks. You can keep 18% of your NDTL either in the form of cash, or you can keep gold, which relatively easily you can convert into cash, or you can keep government securities, which also relatively easily you can convert to cash. Because if you have government securities, there is a big market for government securities where people are willing to buy these government securities at any given point of time. So buying a government security means, imagine you have given the loan to government, then if I buy the government security, it means that government is obligated to pay me back. Whoever holds the government security will get back the loan. It is almost equivalent to currency note, because currency note you can look at it on it says I promise to pay the bearer, and government security will also have written the same thing. Only government will actually pay, you can say, cash in exchange for this government security. You understood this? So banks keep some amount of deposit in liquid assets like cash, gold, government security. If bank buys government securities, then they get interest. But if they keep gold, will they get any interest? If banks are keeping gold for SLR, will they get anything? No. If they keep cash, what happens? Will they get anything? No. In fact, the cash will depreciate because of inflation. So that means usually they don't keep cash, usually they don't keep gold. Majority of the time the banks are keeping government securities for SLR, because if they hold government securities they will get interest. You understood this? If banks buy government securities they get interest, it will be reduced to 18% in a phased manner by 2020. So that means earlier it used to be 40% in 1990. 40% means all the money that is coming as NDTL into the bank, out of this 40% went to be given as loans to government by buying government securities. Only remaining 60% was given as loans to people. So Narasimhan committee in 1991 recommended slowly we have to reduce it to 18%. By 2020 we came to this 18%, and since then we have maintained it at 18%. So this is SLR. So all scheduled commercial banks, it is mandatory for them to hold SLR. Scheduled commercial bank means a full-fledged big bank, whatever we can think of, like normally SBI, ICICI, HDFC, all these type of banks are called. Why is it called scheduled commercial? Schedule means at the back of the constitution there are schedules, at the back of textbook there are lists, right? All these lists are called schedules. Similarly, at the back of RBI Act there are schedules, and in second schedule they have listed out all the banks which RBI has given license to, and that is called, whatever is given license by RBI, they are called as scheduled commercial banks. You understood this? So this way government gets loans, because when they buy government securities, where is the cash going? Cash is going to government, because government security means what? It is a loan given to government. So, and also stability of the banking system is maintained. How stability of the banking system is maintained? What does the entire stability of banking system rest on? Confidence of depositors, trust of depositors. Because now SLR is liquid form, that means easily it can be converted to cash. When somebody comes and asks the money back, then they can easily convert whatever they have government securities into cash by selling it, and then using that cash they can pay back the depositor. Because they can pay back the depositor, you can say that overall stability of banking system in India is high. 18% is significant amount. Along with that we have CRR of 4% also. In USA they don't have this kind of, you can say, serious regulations, first thing. Second, they have ability to invest in other things also. In India only these three, but they can invest in other things also. They invested in different things and their valuation reduced. Imagine 100 rupees depositors money they took, and then they invested, this reduced to 80 rupees. Will they be able to pay back depositors now? If they are asking that 20 rupees, they will not be able to pay back. If they don't pay back, then it creates a bank run. Everybody runs to the bank, and this leads to collapse of the bank. You understood this? So this is basically SLR. CRR, SLR put together, yeah.
Can the banks keep, let's say, foreign securities as a part of the SLR?
Foreign securities,
Let's
that means
the ones issued by the Federal Reserve, let's say.
so banks cannot keep those. Banks, if they get any foreign securities, they can give it to RBI, they can exchange it with cash, and they can bring it and they can keep, maybe government securities or cash, they will keep it. Foreign securities, foreign bill, treasury bills, foreign government, securities, foreign dollars, everything will actually go to finally RBI. If they want to exchange it, it will go to RBI. So CRR, SLR both are counted on fortnightly basis. Fortnightly means average of this, you can say 14 days is taken. If it is not maintained, bank will have to pay penalty interest rate to RBI, which is linked with bank rate. We just discussed how this penalty rate is decided. It is calculated on the basis of bank rate. They help in maintaining monetary stability. Monetary stability, whenever you see it, it simply means the confidence of the depositor on the banking system. Look at this question. If RBI wants to inject more liquidity in the system, it should increase CRR. If we increase CRR, what happens to liquidity? It will actually reduce. Increase SLR. If we increase SLR, also it will not bring more money into the economy. Decrease reverse repo rate. Reverse repo rate and inflation, how are they related? Inversely. Inflation means what about liquidity? If inflation increase means liquidity will increase or not? Yes. So when we reduce reverse repo rate, will it increase liquidity in the economy or not? Reverse repo rate, and so when we reduce reverse repo rate, first liquidity will increase and then inflation will increase. Because if inflation has to increase, what should happen to liquidity in the economy? It should also increase or not? Only when liquidity is high in the economy, this will lead to increase in inflation. That means when we reduce reverse repo rate, cash in the economy will increase. So we'll draw this map. RBI, bank, economy. Reverse repo rate has increased. Bank has more incentive to give more loans to RBI. So less loans will come to economy. If less loans to come to economy, rupee will reduce. If rupee reduces, inflation reduces. You understood this? So if you are not able to understand directly, then use this sort of map so that you get clarity. Right now, decrease in reverse repo rate, will it lead to? So if RBI wants to inject more liquidity in the system, if we reduce this reverse repo rate, here we just took example of increase of reverse repo rate. If we reduce this reverse repo rate, what will the bank do? It will give more money to people, not the RBI, because reverse repo rate is low. That means this is correct. Decreasing the repo rate, this is also correct or not? Yes. This part everybody is already clear. In this question both are correct. If both are correct, you might have seen in, you can say, instructions in UPSC prelims question paper, you have to choose the most appropriate answer. In some questions there are actually questions where all 4 options are also correct and still you have to choose one only, because the nature of the exam is you have to choose one. Which one among these would you choose if both are correct? Repo rate. Why repo rate? Because it is more direct, first thing. Then
there's no guarantee that decrease reverse repo rate will lead to.
There is no guarantee. Okay. And also, which one is actually primary instrument of monetary policy right now? It is repo rate. So that means, think of it like this, you will get 1 or 2 logic. Based on that, you can decide whenever there is ambiguity, to disambiguate between the 2 options, you have to think about among the 2 which one is more appropriate. And this is how, there will always be 6 to 7 questions in the exam. In, like I said, in all the prelims, if you see one time there were much more, 8 questions, somebody filed a case in Supreme Court against this also. But they said whatever UPSC says is final. So that means you can see there will always be ambiguity in some questions. And that is why we usually tell you that you have to score 120 marks. Because cutoff is only 85, 87, 88, that much only. But if you try to target 120, then all this ambiguity don't matter at all, because all the ambiguity put together is only 10, 12 marks. And if you are 20 marks ahead, it won't matter whether this question is correct or wrong. You understood this? Look at this question. Find the correct statement about SLR. To meet SLR, commercial banks must keep cash only. The statement is correct or wrong? Why is it wrong? Because they have given only cash they can keep, but cash only is wrong. If one is wrong, which one can you eliminate? SLR is maintained by banks with themselves. If this is correct, if second is correct, which one can you eliminate? You can't eliminate. Imagine you don't know this, but it is there in both options. Then even if you don't know this statement, you can be sure that it is correct. SLR restricts the bank's leverage in pumping more money into the economy. This is correct. If SLR is increased, banks have to keep more money with themselves in the form of government securities or something. That means you can say this is correct. If this is correct, answer is C. When RBI reduces SLR by 50 basis points, basis point means 100 basis points is 1%. So 50 basis point will be 0.5%. So now, imagine SLR has been reduced. As of now, SLR is 18%, it has been reduced to 17.5. That means what will happen in the bank? They don't need to keep 18% government securities, they only need to keep 17.5. Remaining 0.5 worth of government securities, what will they do? They will sell them and bring cash. Once they bring cash, what is the business of the bank? What will they do with it? They will give loans. If every bank in the country will give little bit extra loans, what happens to supply of loans? Supply of loans increase, demand is same. What happens to interest rates? It will reduce. You understood this? India's GDP growth increases drastically. It has no direct relation. Drastically is also there. Whenever this sort of extreme type of word is there, probability that this statement is true will reduce. You understood? Foreign institutional investors may bring more capital. So direct relation with foreign investors is not present also. Scheduled commercial banks may cut their lending rates. May cut. That means you can say there is a possibility. Even if there is one possibility, this statement will become correct. It may drastically reduce liquidity in the banking system. It actually increases first thing, then drastically is also present. You can see this is second one is wrong. So answer is C. Everybody is clear so far? So, any questions until here? Next is MSF. MSF is a relatively recent measure. That means 10 years ago it did not exist. MSF means marginal standing facility. Sometimes what happens is, we saw so far many options for the bank to make sure that when depositor is asking money back, they will be able to give it. One is CRR, second is SLR. Then from other banks they can take loans, from RBI they can take loans. These are all possibilities. But there is one problem. SLR should be how much? SLR should be 18%. If SLR is kept at 18%, and imagine at this point there is some depositor coming and asking money back, and they are unable to get loans from elsewhere, and in this case their option is going to RBI and bringing, you can say it is possible to bring a loan, but SLR is 18% and they have exactly 18% worth of government securities with them. Imagine they will use the same government securities to bring a repo rate loan. What happens here? How much government securities are there right now? 18%. If they use them, what happens to the government securities? How much will they be keeping? Lesser than 18% or not? Then what happens? Then there is penalty from RBI. So in this case, they cannot bring a loan from repo at repo rate because the penalty from RBI will be very high. Along with that, they have to pay repo rate. You understood? So we have created a situation where even though only exactly 18% is present, they will not be able to bring a loan under repo rate from RBI because they have to keep this government security as collateral. You understood? In this situation, RBI felt that we have to give some sort of relaxation for banks, and so they said that, see, you can violate SLR, but with some limitations. Only up to 24 hours you can take a loan from RBI by violating SLR, and only up to 2% of NDTL you can violate SLR, and you can take a loan from RBI. And the interest rate also, it will not be exactly equal to repo rate, it will be slightly higher, that is 6.75%. Currently you can say maybe it is, sometimes it is made equal to repo rate also, but normally it will be slightly higher than repo rate. You understood this? Everybody understood the situation here. This is a situation when bank has exactly 18% government securities, and also it needs to convert this, you can say they need extra liquidity, extra cash. But if they pledge these government securities with RBI and bring a repo rate loan, then they will violate SLR. If they violate SLR, what will RBI do? Impose penalty on the bank. To prevent this possibility of penalty, so you can say, ultimately RBI is, you can say, guardian of banking system. It has to make sure that this person will get the money back somehow. And that is why what RBI has done is, it has, you can say, allowed the bank to violate SLR, take 2% of this and pledge it with RBI, bring a loan, and only up to 24 hours. You understood? So I'll try to give you an example with which you can understand. Imagine totally 100 crores is NDTL of the bank. In this case, they have, imagine 20% of NDTL they have as government securities. Some one person comes and he asks 5% of NDTL at once, huge amount of money at once. So this bank, what can it do now? 5% he is asking. 2% they can give directly, you can say from here. That means whatever 2%, 18% they can hold, right? 2% extra they are holding. They can pledge this and bring a repo rate loan or not? They can bring repo rate. Among this 5%, 2% they will bring under repo rate, and remaining they cannot bring under repo rate. So what will they do? Under MSF, how much they can bring? Extra 2% they will bring under MSF, and still 1 more percent is remaining. For this, what will they do? What else is remaining? Bank rate. That means for that 1% they can only bring it under bank rate, and finally they will bring it and they will pay back the depositor. You understood this? This is how MSF is working. It is just smoothing this, you can say, transaction, so that the bank will not face a big loss by violating this SLR. You understood this? This is why MSF has been introduced, and currently it is being used.
Sir,
Yeah.
which kind of bank will participate in MSF, sir? Public sector bank or
Scheduled commercial bank. All scheduled commercial bank.
will not be allowed?
Public sector bank will also, okay, meaning of scheduled commercial bank is, it can be public sector bank, private sector bank, foreign bank, all of them are part of scheduled commercial bank itself. Scheduled commercial bank is a umbrella term for all big licensed banks, including government bank, private bank, foreign bank also. You understood this? This is last year 2021 question. In India, central banks function as a lender of last resort usually refers to which other following. So they are basically asking a very simple question. What is the meaning of lender of last resort? Lending to trade and industry bodies when they fail to borrow from other sources. Is it true or false? it is false. If 1 is false, A is eliminated. Providing liquidity to banks having a temporary crisis, probably true. 2 has to be true. That means lending to governments to finance budgetary deficits. Lender of last resort is not usually used in the context of governments, it is used only in the context of banks. So that means 3 is wrong. If 3 is wrong, answer is B. You can see that they are not asking complex questions. We are usually going a little one step ahead, so that even if they ask a slightly difficult question, you will be able to answer. But majority of the questions are simple questions in exam. You understood this? So far we have covered quantitative measures. Among quantitative measures, we have yet to cover one part. This is slightly complex. You have to understand all this, then only you will understand this corridor. Everybody understood all these, you can say, quantitative concepts. Anybody did not understand anything, you can ask. Everybody is clear? Okay, now coming to monetary policy corridor. Earlier we saw that the bank had many options. When depositor has deposited money, is asking money back, bank had many options. 4% CRR, 18% SLR, other banks also option, and RBI, repo rate and bank rate, all these are options available. So, but when will the bank go to RBI? It is last resort, means probably 99 out of 100 times it will be using other mechanisms. Only 1 out of 100 times when nothing else is available, then only it will go to RBI or not. That means by setting only RBI's repo rate, can we control all the remaining 99 transactions also, or only one transaction will be the question. You understood this? So RBI, even though it is actually setting repo rate for only that one transaction, by using this repo rate, reverse repo rate, it will control this entire market. That is, market means interest rates between which, how are these interest rates measured? In call money market and notice money market, what is the indicator? MIBOR, we just saw Mumbai Interbank offer it. So right now, consider for example, bank A needs money because depositor is asking money. And bank A, it can go to RBI. RBI has set repo rate, imagine at 4%, reverse repo rate at 3%. For simplicity, let us assume like this. In this case, bank A can go to RBI. If it goes to RBI, it will get it at 4%. But if it wants at a lesser rate, so it will go to bank B and it will say, I want a loan. If bank B says, I will give it at 4.5%, will bank A accept it? No. Why? Because RBI itself is giving at 4%, bank A will not accept it. So bank A will say no. Then bank B says, how much do you want? Imagine bank A says 2.5%. Will bank B give it? Why it will not give it?
Because it is getting 3%.
Because it can directly give to RBI at 3%, that is why it will not give it. That means you can see that the interest rates between banks, what are the limits for these interest rates? On one side it is repo rate, on the other side it is reverse repo rate. RBI, by setting repo rate and reverse repo rate, is not just controlling that one transaction. It is controlling every transaction that happens between all the banks. You understood? The distance between repo rate, reverse repo rate, whatever was there, it used to be called as monetary policy corridor. Then what happened was, along with this, recently we created this MSF. When will this MSF come into picture? When a bank does not have enough government securities to pledge with RBI, then MSF comes into picture. In this case, imagine the bank does not have enough government securities. MSF, imagine, is 5%, just for simplicity. If MSF is 5%, here RBI is going to give loan at 5% to this bank. So now A goes to B and asks, say, I want a loan, but I don't have government securities to pledge. Maybe I'll pledge something else, whatever they have, gold or some other securities. So B says, if you go to RBI anyway, you will get only 5%. I will give you loan at 4.5%. Will you accept it or not? Yes, because if it goes to RBI, then it has to give 5%. Still it is beneficial for A, so I will accept it. Earlier, this monetary policy corridor was moving only between repo rate and reverse repo rate. Now it is going up to MSF also. You understood this? This is the meaning of monetary policy corridor. Then what happened was, during COVID, RBI, during demonetization, what happened was, everybody probably remembers demonetization. A lot of people, depositors, stepped in queues. Even I was standing in one of these queues and I deposited money in the bank. Probably you will remember, you also have deposited money in the bank. If so many depositors have deposited money in the bank, what happens in the bank? What has increased? Liquidity. This liquidity is asset or liability for the bank? It is a liability. So what will the bank do usually with this money? They will try to give it as loan. They may park it with RBI, but that is temporary. If they have to permanently solve this problem, they have to give it as loan. If they all try to give, every bank tries to give loan at the same time, what happens to interest rates? Interest rates will crash at once because during demonetization, a huge amount of money had come into the bank. You understood? This was a problem at this point of time. So, RBI wanted to take this money to park it with RBI. RBI has to pledge government securities or not? Under reverse repo rate, they have to pledge government securities. RBI did not have adequate government securities to pledge with the banks. You understood this? If it does not have enough government securities, then RBI is limited in its ability to absorb this liquidity. So then they felt the need for an alternative mechanism. Right now we have reverse repo rate where RBI is giving loans by, you can say, keeping government securities. Another option available is bank rate, where without and keeping anything as collateral they can bring a loan. And from RBI's side, we have, you can say, one is repo rate and another is bank rate. RBI has reverse repo rate where it can take loans from banks, but similar to bank rate, does RBI have anything where it can take loans without any collateral? It did not have so far, and that is what we have created right now. It is called as SDF. SDF means Standing Deposit Facility. You understood this? SDF means who is taking the loan? RBI. Who is giving the loan? Bank. Interest rate is called as SDF rate. What is the collateral? There is no collateral. You understood this? Now, once SDF was created, RBI felt that if SDF is there, then why should we take loans under reverse repo rate? So what has happened is now primarily RBI is using only SDF as primary instrument of monetary policy, and it has stopped using reverse repo rate. You understood? So now this whole, you can say, monetary policy corridor has shifted and reverse repo rate has been replaced by SDF. So right now monetary policy corridor is moving between MSF to SDF. You understood this? So to understand monetary policy corridor, you need to understand all of the things we have just discussed. So it is somewhat slightly complex. That is why I asked you whether you understood the whole thing. Everybody understood what is SDF? SDF is similar to bank rate. In bank rate, who is taking loan? Bank. In SDF, who is taking loan? RBI. Remaining everything is similar, that there is no collateral here, and you can say loan is being taken. Everybody is clear?
Sir,
yeah.
SDF then has to be greater than the reverse repo, right?
Ideally, it has to be greater because risk is higher. But who is setting this interest rate is RBI itself, and RBI is a sovereign authority, so it can set whatever rate it wants. People may not be happy about it, but there is nothing much banks can do here. You understood this? Because finally RBI is a government authority. Even though ideally there should be more risk, we will assume that because RBI is setting it, we can manage, you can say, agree whatever RBI is saying. So this is SDF, same thing I have given here. Banks park funds in RBI for short term to earn interest. There is no government security or collateral unlike reverse repo rate. This is the meaning of SDF. SDF is a very recent phenomenon. Probably, I think last year they created this SDF. It is a current affairs type of question that is possible, SDF. So in exam. So as of now, you can say this SDF is 6.25% and repo rate is 6.75%. Between SDF to repo rate, there is only 50 basis points. MSF is also same as repo rate currently. That means this 50 basis points is what we call as monetary policy corridor. MIBOR is always floating between this 50 basis points only. That means on a given day, if liquidity is low, it will be higher end near 6.75%. If liquidity is high, it will be lower end near 6.25%.
Sir, repo rate is 6.5.
You can check once. If repo rate is 6.5,
MSF is 6.75.
okay, repo rate is 6.5, then you can say between 6.75 to 6.25 it is floating. In the middle we have repo rate. But still it is 50, it is 50 basis points is set. So, everybody is clear that, about this whole monetary policy corridor. On one end we have MSF, on the other end we have SDF. If anybody did not understand monetary policy corridor, it is slightly, like I said, it is somewhat complex. If you have not understood any of these previous concepts, you can try to watch this part again, only this part. Remaining things are all simple, this part is slightly complex. So any questions so far? Now we have covered quantitative monetary policy. Variable reverse repo rate. So reverse repo rate means RBI is giving it. Variable particularly is there in such an instrument? I am not aware. If it is there in news somewhere, if you can send it to me, then I will be able to check it. I don't remember reading about variable reverse repo rate. So far we have studied quantitative measures. Next is qualitative measures. Any other questions so far? No questions. The pace is fine now. I have reduced a bit. If it is still not fine, I can reduce it little more. If it is fine, I will continue. It is fine. So coming to qualitative measures. Qualitative measures and quantitative measures, there is a fundamental difference between them. Quantity means what? Quantity is amount. Imagine you are buying 10 kg apple, quantity here is 10 kg. Quality means what type of apple you are buying, grade A, grade B or something, quality will be defined. So that means quantitative policy means we are controlling the quantity of money supply. In the economy, how much money should be present? Using CRR, we control how much money. Using you can say repo rate, reverse repo rate, we are all controlling how much money should be present in the economy. How much is quantity? Quantitative policy will decide how much money should go into the economy, should go out of the economy. Qualitative means where within this economy you can say there are multiple sectors. Which sector should get more money is quality of the economy, you can say quality of production will depend upon who is getting more of this money. Some sectors which are not very important for the economy, if they are getting more money, then we may not be able to achieve whatever our objectives are. So we want to ensure that important sectors in the economy will get more money. That is, you can say, qualitative. What is the quality of the loans we are giving? That means quality in the sense, is it going to help the country achieve its final goals? You understood? RBI may impose basically qualitative measures. The most important one is only one. It is called rationing of credit as a generic term, and in India it is called as PSL. Generic means in every country there is some sort of rationing. They call it as rationing of credit, and in India we call it as PSL. PSL means priority sector lending. We have identified some sectors to be priority sectors and we will give more loans to this particular sector. That is what we call as priority sector lending. PSL is a way to provide higher priority to certain economic sectors in our country, giving them better access to credit or loans. Why should we do it? Because we want more loans to go to that particular sector. Banks by themselves will they give these loans to these sectors? What is the interest of the bank? To make more profit, and these sectors may be risky, so they may not give more loans to that sector. That is why government has to force them to do it. RBI will force them to do it using PSL. So what are the important sectors? What exactly we are talking about here? One is food security as a goal. That means agriculture should get more loans. Financial inclusion as a goal. Small farmers or weaker sections should get more loans. Employment as a goal. MSME sector should get more loans so that more employment is being created in MSME. So that means we have identified some strategic objectives and we have decided which sector should get more loans to achieve these strategic objectives, and that is why you can say PSL has listed out them as, you can say, important sectors. So total priority sector loans we are going to give is 40% of A and BC. Earlier we used to give NDTL itself as a loan. That means earlier whatever we saw CRR, SLR. But banks were not happy by using of NDTL, so they created a mechanism which will reduce the burden on the bank. Right now the burden on the bank, you can imagine how much of burden is present. They have to keep CRR, SLR, then they have to give PSL, they have to hold, you can say, provisioning we have not yet discussed, that part also we will discuss, but you can see that huge amount of burden is present on the bank. Because of all this burden, the banks are not able to make as much profit. We wanted to reduce the burden on the bank so that you can say foreign banks will be interested, more people in India will be interested to open banks. So that is why we created this A and BC, which we will see what it is. A and BC will give a lesser number that they have to give as loan. So you can see total PSL is 40% of A and BC. That means whatever they are giving as loan, imagine A and BC, they have to calculate what is 40%. Out that 40% should be given to priority sectors. Agriculture gets 18%. As a sub part of that agriculture, small and marginal farmers will get 78%. What is the meaning of the small and marginal farmers? You can see here greater than 10 hectares is large farmers, 2 to 10 hectares is medium, less than 2 hectares is small and marginal farmers. So they will get 78% and remaining 10% large farmers also, whoever you want you can give, small, large, everything. So this is how for you can say agriculture. Then micro enterprises, 7.5% to micro enterprises. What exactly is micro? Micro means you can say up to 5 crore. Here this as of now there is turnover based definition. That means 5 crore turnover, it is micro enterprise. 5 to 75 small, and 75 to 250 crore it is large enterprise. Recently this was a part of, I think government has named it as a part of Atmanirbhar Bharat reform. Before that we had a different definition, and that definition was, you can see 25 lakh or something, 10 lakh, it was a very small definition. So we have changed it now, and that is why I have added a separate slide. So for micro enterprises we will give, you can say, some 7.5% loans. Weaker sections also. Weaker sections means what? Weaker sections means socially weaker sections, or you can say economically weaker sections also. Socially weaker means we are talking about SC, ST, OBC, and even women, differently abled section. Everything, all these will come under weaker sections. Why are we giving more loans to weaker sections? Because in syllabus if you see, the first 3 lines are, there is also social development, economic development, social development, sustainable development. Social development is present. Social development means we have to ensure that somehow there has to be extra support given to socially weaker sections. You understood this? So that is why we are giving more loans to socially weaker sections. So what exactly is this A and BC? Bank credit, everybody knows what is BC. So in economy I will give you a trick. From backwards, if you don't understand a term, come from the last word and go back. Once you understand credit, credit means loan. Bank credit means loan given by the bank. Net bank credit means we are subtracting something to get net from gross. So what exactly? Bank credit. Imagine in this case bank credit, loans given by the bank. Imagine loans given by the bank, for simplicity let us assume 100 crores of loan has been given by the bank. Net bank credit means total loans given by the bank minus loans taken from other banks. Imagine this bank has taken 20 crore of loan from other banks. Then we subtract it. How much will we get? 80. Adjusted means we are subtracting something else also. Bonds held under obligation like SLR. How much are we holding under SLR? 18%. 80 minus 18 will be how much? CSAT classes you are attending or not? 80 minus 20 is 60, 62. So that means you can see totally 62 crores is on this 62 crore we have to give 40% as loan. Earlier we saw out of 100 crore if we give 40% as loan we have to give 40 crores. But right now on 62 crores only we have to give as 40% as loan. That means it is much lesser or not. By using this method we have reduced the burden on the bank in giving loans. You understood this? Now PSL is only on the 62 whatever is remaining. Why we have subtracted these things? First is loans taken from other banks we are subtracting. First of all, this itself is a liability for this bank or not? So that means they have to pay interest to them and we cannot force this bank to give this money as PSL. Second thing, already this money whatever we are forcing the bank to give 18% as loan to government, that is already a forced loan. So that means that part also we exclude and only on the remaining part we will calculate how much PSL has to be given. 40% of this remaining part 62 crores is PSL. You understood this?
Sir,
Yeah.
loanable income of loanable money of the bank is after we exclude the CRR and SLR, right? Whatever is left that is loanable.
Correct.
Then why are we again subtracting SLR from here?
SLR because yes, I mean
Why, like it should be the 80 that we get after minusing 20. That 80 should go to PSL. Now why are we minusing 18 more?
because okay, why we are subtracting it is not because you can say it is not given as loan, it has been given as a loan. We are subtracting it because bank did not have a choice in giving that loan. RBI first of all has imposed an obligation on one at 18 crore. Again on top of that if we impose another obligation on this 18 crore again, then it will be you can say huge amount of obligation for the bank. The whole objective of creating A and BC itself is what? To reduce the obligation of the bank and make it more profitable. You understood?
Sir, that 100 that we have written.
This 100 is already loan given by the bank.
No, that 100 that is the loanable amount that a bank has which it can give.
Okay, you are saying 4% is kept aside, 18% is kept aside,
Yes,
remaining part is
then
100.
Then the remaining part is 100, right?
That is correct.
Then why are you again minusing 18%?
Why we are subtracting the SLR
We have
twice?
already taken SLR 18% out.
I understood what you are saying. We have already excluded SLR, but here why are we excluding SLR? What are we excluding it for? To calculate how much PSL has to be given. We are excluding it not to give, you can say, this 18% is a forced loan given by RBI or not? Yes. And we are subtracting this 18 crore because a forced loan has already been given. So this 18 crore actually, if they have given this as a loan, then it will be part of this, you can say 100 crores. Imagine this 18% is SLR. It can be kept in what form? One is gold, second is cash, third is government security. If they buy a government security, what exactly is government security? Government security is a loan they have given to government. That means, is it a part of bank credit or not? Bank has given loan to government. Think of it like this. If bank has given loan to government, they have not given it voluntarily. They have given it because RBI has obligated them to give this loan under 18%. But imagine out of that 18%, bank has kept some cash and remaining part only they have bought government securities. Then whatever they have given for government securities, that part will be part of bank credit. You understood this?
If SLR was not there as a mechanism, as a forced loan, if SLR was not there,
yeah, then we don't need to.
Bank would have. That is why we are minusing it, right? Because if SLR was not there, then that would be 100 in
yeah, 18 crore extra will be present.
It would be then 80.
Yes. 82. Yeah. So you can think of it like SLR, if it is kept in government securities, it will be part of this 100 crore. So CRR is not exactly a loan given, it is not subtracted. That means you are saying in bank credit is not included at all. So it is separately, we are not subtracting it. From the loan given by the bank, we are subtracting only two things. Whatever is held under obligation under SLR. One more thing is present here. Imagine they are holding much more government securities than necessary, which most banks hold. Imagine they are holding 20%. Then how much we subtract here? Is still 18% only, because obligation is how much? 18% only. You understood this? So this is A and BC. In simple manner, A and BC was constructed so that we can reduce the burden on the bank compared to NDTL. So think of it like this, then it will be simpler. Then probably everybody knows what is there in, there was a question already asked once, which of the following sectors are a part of PSL list? That means a list of sectors are present in PSL, you should be able to identify which sectors are present in PSL. This is a you can say, this list you should be able to identify which are important sectors. Agriculture is important sector because food security is important. MSME is largest employer in India, exports also 45% of exports happen from MSME. Export credit, why do we need to export more from India? So that we earn foreign exchange. Why is it important we earn foreign exchange? If we earn more dollar, using that we can import. For imports we need dollar. To get dollar we need to export. So that means it is basically so that we will be able to import our oil and whatever we need to export. And to increase our exports we are giving some support to exporters through export credit. Education loan, education, everybody has probably heard of human capital. Human capital means it includes education, health. What is the meaning of human capital? Human capital means people who are participating in the economy as labor and creating something. That means they are producing something, or as entrepreneurs are producing something. They are all part of human capital. If they are participants in the economy, they are part of human capital. If they are not participating in the economy, they are not part of human capital. If they have to participate in the economy, what is important? Should they be educated or not? And should they be healthy or not? Along with that, there is one more factor. If there are any social, you can say, obligations for this person not to participate. Imagine somebody who is working in ISRO. This woman is PhD in mathematics now. She has a child after marriage and her in-laws are not allowing her to work. And in this case, she will get out of this human capital. You understood? It doesn't matter how much health education they have. If they are not participating in the economy, then they are not part of human capital. So that means we have to ensure that we have better health, better education, and we have to remove social, you can say, whatever mechanisms are there which are preventing people from participating in the economy. So this is basically important for improving human capital education loans. Renewable energy, everybody knows, since 2015 when we signed Paris deal, renewable energy has become important as a, you can say, sector. Then social infrastructure. What does it mean when we say social infrastructure? Anything infrastructure which creates positive impact on society is social infrastructure. Infrastructure which creates positive impact on economy is called as economic infrastructure. Some type of infrastructure actually creates positive impact on both society and economy. Consider roads, schools, and maybe even hospitals. They will have positive impact on both society and economy. They can be considered both social infrastructure and economic infrastructure. Anything which creates positive impact, including even sanitary toilets also is, you can say, a part of, one is it a part of social infrastructure? This part is important. It is if it is functional, then only it is a part of social infrastructure. Imagine a toilet which is, maybe the latch is not working or door is not present for this toilet. Then it is just a room because nobody is using it. Then it is not part of social infrastructure. A hospital without a doctor, a school without a teacher, they are not part of social infrastructure. You understand this? Only when they are functional, then they are part of social infrastructure. Then rural housing. Rural housing, why is it important? Because it is linked to 100 other sectors, 105 other sectors in the economy. If you focus on housing, building houses, then demand will increase in a lot of other sectors like cement, steel, maybe they are using electrical wiring, flooring. All these type of industries will also be, you can say, getting benefit of building a house. So when we give loans, you can say demand will increase in all these 105 sectors. As demand increases, production will increase, creates virtuous cycle. So these are all important sectors in the economy for this reason. So far we have seen what is the most important, you can say, among qualitative measures. Then margin requirements is also, you can say, next qualitative measure. Margin means, earlier we have seen that RBI is able to control how much money is flowing into the economy through the bank. But it was just pushing money into the economy or taking out money out of the economy. Right now, we want to be able to push money into a particular sector and not another sector. How can we do this? This is done using margin. Margin means RBI would have prescribed, imagine 20% margin as default for every sector. Then what it means is, imagine you keep a collateral of, imagine you want to take a loan of 1 crore, that means for a house, you keep collateral worth 1 crore. Then the bank will say margin, because it is 20%, we can only give the remaining 80% as loan. If you keep 1 crore as collateral, how much will you get as loan? 80 lakh. Margin, that is that proportion of the value of security against which loan is not given. Because RBI has fixed the margin at 20%, they can only give the remaining 80% as loan. That means that 20 lakh, who should bring it? People who are buying this house, that person has to give down payment of 20 lakh. Remaining 80 lakh can be paid as EMI or something. You understood this? This is the meaning of margin. Imagine tomorrow we are just trying to come out of a recession and RBI wants more people to buy houses so that we create more demand. Now RBI reduces the margin requirement from 20% to 10%. Then what happens to, you can say, house buyers? Number of people buying houses will keep increasing now, because now they don't need to give 20 lakh down payment, they only need to give 10 lakh down payment, remaining 90 lakh will be given as loan. You understood? So wherever RBI feels that we have to reduce the demand in a sector, automobile sector, imagine demand has increased so much, the inflation is high. Then what it will do to margin requirement? It will increase margin from 20 to 30%. Then you have to give 30% down payment, only remaining 70% can be taken as a loan. So that means RBI is capable of controlling where the loans will flow easily into which sector, and it is able to curb the loans in some other sectors as well. This is basically meaning of margin requirement. You understood this? Higher the margin, lesser will the loan sanction. When RBI wants more loans to flow to particular sectors, housing, auto, agriculture, they reduce margins and vice versa. That means whenever they want less loans to flow to a sector, they will reduce the margin. Whenever they want more loans to flow to a sector, they will increase the margins. So this is basically meaning of margin requirement. So next, regulating consumption loan. Consumption loan means if a bank is giving a loan, this loan can either go for consumption. Consumption means a person buying something, or it can go for production. Production means a factory is producing something. So imagine a car or something. If it goes for consumption, which of the, you can say, demand and supply between this, which will increase? If it is going towards consumption, demand will increase. If it is going towards production, supply will increase. Imagine demand is outstripping supply, what will happen? Inflation. If we want to reduce inflation, what should we do? We need to create more supply. That means what we will do is, RBI will try to create, you can say, more hurdles for taking more consumption loans. and create less hurdles for taking more production based loans. This is called as regulating consumption loans. You understood this? Directing loans to productive purposes. Too much consumption without production creates inflation, so we want more loans to go towards production. Through using existing mechanisms itself, whatever margin requirements and such other mechanisms, it can try to push more loans towards, you can say, production. Then this remaining part is very simple. Model suasion means if any of the bank is not following the regulations of RBI properly, then you can say try and convince the bank to follow these regulations initially. It is not following any legal mechanisms, but it is trying to put pressure on the bank. Suasion means it is a part of persuasion. You can see the word is similar. Persuading an erring bank to follow the rules. First informally. Informally means they are not exactly forcing them, or they are not exactly, you can say, using any law or power given by government. They are just informally asking them to do it. Then they will send notices if they don't follow this informal advice. Combination of persuasion and pressure, both are involved. Then finally, if it is still not working, direct action means there will be some penalty if they are not following the rule, or stopping repo and other operations. There will be a moratorium imposed. Moratorium means temporary ban. A temporary ban that you cannot withdraw, you cannot add money into the bank temporarily for 15 days, 1 month until RBI decides what to do with this bank. So this is temporary ban. So then cancelling of, finally if nothing works, RBI cancels the license of the bank. So far in most of the cases, what RBI has done is it will cancel the license of the bank and it will ask a bigger bank like SBI or somebody to buy this bank. Because once they buy the bank, depositors will also be protected. And this bank, whoever the management of the bank, they are not following the rules properly, they will be removed from this entire banking system. You understood this? Yeah. Prompt corrective action is it is preventive type of measure more than a curative type of measure. I've given prompt corrective action later. Preventive means we will identify whether there is stress in the bank, identify some, you can say, indicators on the bank, and then we will try to take preventive measures so that the bank will not fail. So it is more like getting your medical tests done once in 6 months. Imagine somebody in their 60s, their cholesterol is increasing or BP is increasing, they will take preventive measures to reduce it, and that is how prompt corrective action is. So far there is no serious risk, but just to ensure that in future risk will not increase, we take measures, that is prompt corrective action. Look at this question. PSL by banks in India constitutes lending to 2013 UPSC question. All of the above. 95. Which of the following is not instrument of selective credit control? Until 95 they had never used this word selective anywhere in textbooks, etc. But UPSC chose to use this because they are trying to differentiate between people who are mugged up quantitative, qualitative, quantitative, qualitative with somebody who can understand what is the meaning of selective here. Selective means which one?
Qualitative.
It is qualitative because we are able to select which sector the money should flow into. So that means selective here, which one is selective? Okay, answer here, question here is not selective. So not selective, CRR is quantitative, so it is not selective credit control. An increase in bank rate generally indicates, when we increase bank rate, market rate of interest is likely to fall. It is wrong because when bank rate increases or any of the interest rates increase, what happens to interest rates in the banks? They will also increase. So that means you can say A is wrong. Central bank is no longer making loans to commercial banks. Also wrong because central bank will always give loans to commercial bank. Central bank is following easy money policy. Easy money means what? Easy money means low interest rate. Interest rates have reduced. So here they are saying it increased. That means it is tight money policy. Easy money policy is also called expansionary monetary policy, loose money policy, and it is also called as dovish policy, D-O-V-I-S-H. And opposite of this, that is hawkish, tight money policy, and also contractionary monetary policy. All of them are referring to same thing. When interest rates are higher, it is contractionary, it is tight money policy, it is hawkish policy. So here this is also 2015 question. Which of the following are part of monetary policy? Bank rate, open market operation, they are part or not? Open market operation means what? Repo rate, reverse repo rate. They are a part or not? 1 and 2 are a part. Public debt and public revenue, they are part of fiscal policy. So answer is 1 and 2. Open market operation refers to borrowing by banks from RBI, lending by commercial banks to industry and trade is not there, purchase and sale of government securities by RBI. So you can see between A and C, A somewhat has similarity, but C is much more appropriate in this. So purchase and sale of government securities. So this is qualitative policy. So far we have covered quantitative and qualitative monetary policy. Any questions until here? This part is important for exam, so make sure that you have whatever I have discussed. This much if you understand, actually you can answer at least those questions, 2 questions, whatever are going to come in exam from this part. So if you found anything to be somewhat you are not yet comfortable, try to make sure you get comfort on that part, because even though it is pure simple static, then still it is still important in exam. 3 predominant types of monetary policy are present, of which India is following the last one, that is inflation targeting is the main concern. Before 2016, actually Urjit Patel had said that before Urjit Patel we used to follow something called as multiple indicator method, growth, inflation, employment, exchange rate, everything. But after Urjit Patel Committee 2016, we are following only single, you can say, objective, major goal, or our major goal is only controlling of inflation. But there are some export oriented economies like China, where exchange rate stability is actually the main concern of monetary policy. What is the meaning of exchange rate? Exchange rate means if we convert our currency rupee to dollar, how much rupee should we give to buy dollar? That is the meaning of exchange rate. As of now, let us assume for simplicity 85 rupees we are giving to buy $1. This is the meaning of exchange rate. How does this exchange rate work? Just like there is a market for everything, it could be loans, it could be tomatoes. Same thing for dollar and rupee also there is a market. Just imagine somewhere in the middle of Pacific Ocean there is some warehouse in an island where everybody is standing like a market and people are holding on their table heaps of dollar, heaps of rupee, etc. This is the international currency exchange market. And here exactly how people are buying brinjal and tomato, they are buying and selling rupee and dollar. And if you understand this, if you get this in your mind, entire external sector is extremely simple because it is following the same market transaction only. And in this warehouse what exactly happens? If you have to buy $1 from that person who has dollars, you have to give 85 rupees to buy it. What decides the price of anything in the entire world? Demand and supply, and that is exactly what determines the price of dollar and rupee also. So what makes people demand a particular currency? Why do the people need dollar or yen or euro or renminbi? Why do they need it? Because they need that currency because they want to buy something from that country. So countries which export more, their currency is demanded by everybody across the world. Countries which are not exporting much, their currency is not useful for other people. You understood? The demand for a currency is dependent upon how much they are exporting. This is primary. Maybe other smaller reasons are also present, but the primary reason is if a country is a big exporter, what happens to demand for that currency? It keeps increasing. So you can see that if a country is big exporter, the currency's value keeps on increasing. First thing, you understood what is exchange rate. Second, you have to understand what is appreciation and depreciation. If you can imagine next month we have to pay 90 rupees to buy $1. What has happened? This is called depreciation. Even though it looks like number has increased, it is depreciation. Why? Because we are giving more to buy, you can say same, that means our money value has reduced, dollar value relatively has increased. That is what we call as depreciation. Appreciation means if it becomes 80, it is appreciation. 80 to buy $1, it is appreciation. Depreciation, appreciation means in the market automatically according to demand and supply the value is changing. Devaluation and revaluation is similar to depreciation, appreciation in its effect, but we are deliberately doing it in the international currency exchange. How do we do it? If imagine RBI wants to reduce the value of rupee, what should it do? It should increase the supply of rupee. RBI takes some money from cash from here, it will try to sell to everybody, whoever is there. When we sell it, what happens to supply of rupee in the market? Supply has increased, demand is same. What happens to value of rupee? Value of rupee reduces. This is what we call as devaluation because we are doing it deliberately. Imagine the opposite. If RBI wants to increase the value of rupee, what should it do? It should reduce the supply of rupee there. How to reduce supply of rupee? We have to buy rupee. We have to buy rupee from whoever has it. If you have to buy rupee, what will they accept? Some other currency which is valuable. We have to pay dollars. This is what RBI recently did. India used to have around $750 billion of cash in the form of dollars. But right now we have only around 450, 500 because We used these dollars to buy rupee from the currency exchange market so that whatever depreciating rupee is there, we will be able to stabilize it at the same level. You understood this? So that means this is what we have done to stabilize the rupee. To make sure that depreciation of rupee will stop, RBI has actually bought the rupee from the currency exchange market. You can see that central bank will interfere into currency exchange market and try to control the value of it, value of the currency. So you can now look at the first one, exchange rate stability as the main concern. Some countries which are export oriented economies, let us take China for example. Imagine China is exporting something to USA. India is also exporting, imagine India is exporting mangoes, China is also exporting mangoes. And Indian currency value right now is 100 rupees and Chinese currency value is renminbi. $1 they are getting 100, $1 they are getting same 100 rupees also there. 100 rupees is 1 kg of mango. So in a US supermarket, if a US citizen is buying Indian mango or Chinese mango, will it make any difference to them? No, both are 100. But right now China is an export oriented economy. Imagine by next year summer mangoes will be released. By then what happens is everybody is demanding Chinese currency around the world because China exports a lot to everybody. As China is increasing its exports, everybody is demanding more of Chinese currency. What happens to overall demand for Chinese currency? And because of this reason, what happens to Chinese currency itself? Natural tendency of an export oriented economy's currency is to appreciate. If you don't do anything, automatically it will keep appreciating. If Chinese currency appreciates, what has its value become? From 100 rupees to $1, if you give 100 renminbi, you will buy $1. From this appreciation means, imagine it went to 50. 50, if you give 50, you will get $1. This is the present situation. And now, if imagine in US supermarket, same 2 trays of mangoes are present, one is Indian, one is Chinese. Indian mangoes, if you give $1, you will get how many kg? For 100 rupee, you are getting 1 kg. Chinese mango, if you give $1, how much you will get? You can only get 50. That means you can buy only half kg mango or not. As Chinese currency appreciates, what happens to Chinese products abroad? They are becoming more expensive. If they become more expensive, what happens to China's ability to export? It will reduce. You understood this? So that means a natural tendency of an export oriented economy is that its currency value is consistently increasing. So what should China do here? China will try to keep its currency stable. How will it keep its currency stable? How will it do devaluation? It will bring some Chinese currency to this international currency exchange market and it will sell Chinese currency to anybody whoever wants it. And when China is selling currency, Chinese currency supply will increase, demand is also increasing, supply is also increasing, its currency value will remain same. You understood? This is the meaning of exchange rate stability for export oriented markets like Singapore, whichever are export oriented markets, this is what they do. They don't consider inflation to their primary concern because their GDP is not coming primarily from within, it is coming from outside the world. You understood this? Everybody understood what is exchange rate. This is a foundational concept in economics. If you understand this part, entire chapter of external sector will become very simple because all you need to understand is what is exchange rate, how does it determine demand and supply, depreciation, appreciation, and a central bank can control it. You understood? So this is, you can say Indian government is not primarily concerned with exchange rate. We are not a big exporting economy. Mostly you can say exporting economies are interested in this. Some factual information about RBI. This Daksh web publication is for compliance. Compliance means what? RBI makes rules, so every bank has to follow these rules and all other regulated entities, NBFCs also have to follow rules. This Daksh is used to make sure everybody is following CRR or SLR, whatever rules RBI is making. Then Retail Direct is also a portal, it is also a scheme. Retail Direct is where people can directly go to this way, you can say website and buy government securities. Banks can buy it, people can buy it, anybody who wants to buy it, they can buy it on this portal called Retail Direct. In the name itself, directly any retail buyer can buy government securities, that is why it is called Retail Direct. E-Kuber is actually where banks can, you can say, do transactions with each other. That is the core banking solution software, that means the core software of RBI where banks will transact with each other. So, any questions so far? In exchange rate, everybody understood this part. So, if you understand this part, probably there will be one or two questions which you can answer using this understanding in exam, because this is foundation for everything that happens in external sector. So coming to real sector, real sector, financial sector, there is a difference in economy. Whatever is not present in financial sector, everything is real. Means you give money and you buy a product or service, that is real sector. Financial sector means you buy some instrument which will give you money back only. You give money, you receive money back, maybe more money. It is some sort of investment. Buying shares, buying bonds, giving loans, all this is financial sector. You understood? So simple way to understand financial sector is you are giving money or receiving money back only, same money back. But when you are in real sector, imagine you buy a packet of Lays. Is it a real sector transaction or financial sector? It is real sector. Imagine you buy SBI shares. It is financial sector transaction. You understood the difference between real and financial sector. So whatever is not in financial sector, everything else will fall under real sector. Real sector consists of enterprises. That means non-financial corporations. Non-financial means enterprises which are producing actual products and services except financial. Households, non-profits, everything which is not financial, non-profits, even they will also come into non-financial sector. It does not contain financial institutions like banks and NPAs which are involved only in purely financial type of transactions. It does not contain financial instruments issued by imagine Reliance issues bonds. Will this be financial sector or non-financial sector? It will be financial. Reliance actual business is maybe internet or SIM card or something, but it is issuing financial sector instrument, then it is a part of financial. That instrument is a part of financial sector. You understood this? This is the difference. This is the meaning of real sector, financial sector. In simplest terms, think of it like this: giving money, receiving money back is financial sector. Giving money, receiving a product or service is real sector. This is last year question. Which of the following activities constitute real sector in the economy? Farmers investing in their crop, harvesting their crops. Farmers are harvesting crops means it is a real sector transaction or not? Textile mills converting raw cotton into fabrics. Real sector. Commercial bank lending money. This is financial sector. So answer here, imagine 1 and 2 should be there. 1 should be there. 1 should be there means 2 is gone. 2 should be there means. So no, 3 should not be there. Then D is also gone. So answer is, you can see 4 just to verify whether your whole thought process is correct. Corporate body issuing rupee denominated bonds overseas. They are bonds and that means it is financial sector. You understood this? So this is also last year question. What is the most widely used monetary policy tool? What should you get in your mind immediately is repo rate. If repo rate is not there here, then open market operations will have within it what? Repo, reverse repo are there in open market operation. So you can think of it as answer is B. None of these also is a considerable option, but because repo is there in B, you can choose B. So next, NPAs, will take a break here and after 15 minutes we'll continue with NPAs. Welcome back everyone. So far we have covered quantitative and qualitative monetary policy. Next part is related to NPAs. Earlier we have seen what is the meaning of an asset for a bank. Asset is when they give a loan to someone, it is called as an asset because this person is going to pay back interest. When will an asset become non-performing is when this person is not paying back the loan or interest, and that is what we call as a non-performing asset. Asset is a loan. Non-performing asset means it is not doing what it is supposed to do, that is earn money for the bank. Then it is called as a non-performing asset. So how do you define a non-performing asset? In general, for all sectors combined, we just define it. We say that for a 90 days, if somebody has not returned principal or interest, it is called non-performing asset. Only for agriculture, we have a different definition. Two you can say separate, you can say different types of crops have two definitions for NPA. One is short duration crop. Short duration means 2 months, 3 months type of crops like paddy, jowar. In this, for 2 crop seasons, if they don't pay back the loan, then it is NPA. And for a long duration crop like say sugarcane, which has 1 year tenure, and in this case, if for one crop duration around 1 year, if they don't pay back the loan, it is called NPA. This is how we have defined NPA for agriculture, because agriculture sector they will not get back their money immediately. Only when they do harvest of the crop, then they will get the money, then only they can pay back the loan. That is why we have changed the definition for agriculture. But otherwise for everybody else it is 90 days. Everyone is clear with definition of NPA. Some terms which are simple terms related to NPAs. Standard asset means what is actually people, if they are paying their loan back, then it is called standard asset. Performing asset, also called a standard asset. Secured and unsecured loan is very simple. If you have collateral, kept collateral and taken a loan, then it is called a secured asset. If there is no collateral and still the loan is given, then it is called as unsecured asset or unsecured loan. Which one is more riskier? Unsecured loan. Which one will have lower interest? Secured loan, because it is less riskier, it will have lower interest, and unsecured loan is higher risk and higher interest. Then coming to provisioning. Provisioning means usually a bank has given a loan to someone, this person, imagine this loan becomes NPA, and once it becomes NPA, there is a possibility that this loan will not come back. And if it does not come back, then who should pay this money back to the depositor? Depositor ultimately has to get the money back. So the bank gives its own money, what we can consider as capital of the bank, it will convert it into depositor's money and then give it back to the depositor. Because ultimately the bank cannot do anything against the depositor. Ultimately we have to protect the interest of the depositor and confidence of the depositor in the banking system. So what is the meaning of capital of the bank? Where does it come from? Capital means what? We saw land, labor, capital, entrepreneurship. Capital means, capital is investment. The shareholders of the bank have given this money to the bank. Usually capital of a business is used for expansion of business, to open new branches, to buy software, to hire employees, to give chai samosa to employees. This type of normal expenses of the bank are, you can say, coming. Where is the money coming from? It is coming from capital. They cannot use depositors' money for all these purposes. They can only use capital of the bank. These two are completely different money. Capital of the bank is bank's own money, and depositors' money is depositors' money. It can only be used to give loans. You understood? Now if depositors' money does not come back, then capital of the bank should be used to compensate the depositor. So this is basically, so difference between depositors' money and capital of the bank. Now imagine a loan becomes NPA. Immediately once it becomes NPA, RBI has created rules that some money here has to be kept aside as provisioning from capital of the bank. They have to keep aside this money and they cannot use this money for expansion of business. They cannot spend it on, you can say, buying in new things for the bank, etc. Because there is a possibility this loan will not come back at all. And if it does not come back, then what should we do? We should use this provisioning amount, whatever we have kept, to pay back the depositor. Everybody understood what is depositor's money and what is capital of the bank? Capital means bank is a business. For any business, there will be shareholders or owner of the bank. Owner would have given some money to set up the bank. That is called capital of the bank. Or the bank is earning profits here. Earlier we saw this is 4% deposits are getting, 8% this person is paying, 4% is profit of the bank. This profit will actually go to capital of the bank. You understand? So capital of the bank can be used for what purpose? Expansion of business of the bank, that means opening new branches. Depositors' money can be used for what purpose? giving new loans only. There are only very few things that they can do with it. They can buy government securities, that is also giving loan. They can give loans to people. They can buy maybe gold sometimes, and that too there will be a limit on how much gold they can buy. So that means you can see the depositors' money, there is a clear restriction on what they can do with it. Whereas for capital, it is their own money, they can expand business, they can do whatever it is they want. So this fundamental difference between these two is very important to understand further concepts. Everybody is clear about the difference between capital of the bank and depositors' money. If anybody is not clear, you can ask. I'll try to repeat it in a different manner. If you want, I'll repeat it. Everybody is clear. So now come to provisioning. For every loan given out and becoming NPA, that means once a loan becomes NPA, banks keep aside some extra funds to cover up losses if something goes wrong with the loans. Imagine 100 loans have become NPAs. Out of that, probability that maybe 20 loans will not come back at all is very high. So maybe 20% of the money, you can say, of this 100 loans is kept as provisioning. So imagine when these 20 loans don't come back at all, then this 20% money is used to give back depositors. You understood? So this is how, in any business there is normal risk. Imagine a tomato seller. They will buy tomatoes, they will keep selling tomatoes. Some tomatoes in the middle, they will rot here and there, and there is a loss to the tomato seller. Similarly here, rotten tomatoes here are these NPAs, those loans that are not coming back. There is a loss to the bank. Then who will compensate for this? The tomato seller, using his own money, they is making a loss there. Same way here, the bank, whichever investment it has done, it is making a loss from that. You understood this? So basically, provisioning means RBI has made a rule that once a loan becomes NPA, a percentage of that loan should be kept aside here from the bank's, you can say, capital. This is what is the meaning of provisioning. For a LAF. Okay. CRR and SLR is kept from whose money? Depositors' money, because depositors' money 4% NDTL means liabilities. Liabilities means depositors' money. CRR SLR is kept from depositors' money, whereas this bank's own money, capital, is different. It is coming from shareholders. These two are different.
So the money for provisioning, will it be only for the NPAs or for each loan that the bank is given?
It is only for NPAs. It is for each loan they will not keep provisioning. For NPAs they have to keep provisioning. How much provisioning they have to keep is also clearly defined by RBI. If it has become NPA and you can say 1 year has elapsed, more than 1 year has elapsed, so then they have to keep on increasing how much provisioning they have to keep also.
Sir, so if let's say if the loan has become an NPA, so whatever, if there is a collateral, so they can, like the bank can sell the collateral and get the money, right?
Okay, if loan becomes NPA, can the bank sell collateral?
Then there is no need to do provisioning.
Correct. But the problem is, when a loan becomes NPA, the collateral that is kept in the bank, who is the owner of this collateral? Owner is still the person who has taken the loan. The ownership is still with him. The bank is only a trustee of this collateral. According to law, only owner can sell it. Trustee cannot sell it. If trustee has to sell it, then court has to give an order to change ownership from the owner to the trustee. That means they have to go to court, and the court will take, in India, court takes 10 years, 20 years by the time this whole thing happens. So that is the problem with NPAs. You understood this? Yeah. Correct. Bank will keep only once it becomes NPA. RBI has created rules that you have to keep provision. Before it becomes NPA, they don't need to keep provisioning. What they keep at that time is different. It is capital adequacy ratio. It's different. We'll see that later. But right now, provisioning is only kept if it becomes NPA. You understood this? So then classification of NPAs. Once NPA, you can say it is declared as NPA. You can see NPA is after 90 days. Up to 12 months, it will be called as substandard asset. If it is more than 12 months and still we have not been able to recover anything, it is doubtful asset. It means it is doubtful whether it will come back at all. After this, usually there is no time period, but by convention banks follow 3-year time period. Once 3 years is over, then somebody has to sign on it. Some auditor, internal or external auditor will sign saying that this is a loss asset, we will not be able to recover it. Once it is a loss asset, it is removed from the assets column of the bank. Then once it is a loss asset, it also means that capital of the bank should be converted to depositors' money now, and using this money we have to pay back depositors. You understood? Declaring it as a loss asset means we have to convert capital of the bank into depositors' money. Everybody understood what is substandard asset, and depending upon time period these two, and this one it is not exactly based on time period. Bank can declare it whenever it wants as loss asset by signing by the auditor that it is a loss asset. So earlier only this much was there. Later RBI felt that too many NPAs are happening, and before it becomes NPA itself, we should be able to take a preventive type of action. So that means we wanted to measure what is becoming NPA before it becomes NPA. So they created a stressed asset classification. Stressed asset means not yet NPA but probably will become NPA. When will we know it? 1 to 30 days delay. Imagine EMI, one EMI is skipped. That is 1 to 30 day delay. SMA is 0. SMA means here special mention accounts. Special mention means that it is not yet NPA, but if before 90 days, 1 EMI missed, 2 EMI missed, or something like this, we will declare it as SMA 0, special mention account 0, 1 and 2. And once it is in 0, they have a tiered action. That means first tier they will just call up the person and say, why you are not paying, did you forget or something. Second tier they will call twice a week or something. Third tier somebody visit their home saying if you don't pay now it will become NPA. So that means we are trying to avoid maybe 20-25% NPAs actually reduced after this whole new classification was created, because people were persuaded to pay the loan and before it becomes NPA itself. So this is called as stressed asset classification. Stressed asset means not yet NPA but maybe it will become about to become NPA. That means how many days has happened since they paid their installment. Then coming to gross and net again. Gross and net means we already know something has to be subtracted. What is subtracted in this case is gross NPAs minus provisioning is net NPAs. Imagine gross NPA totally is 100 crore. 100 crore of money is not coming, has not come back of this bank. Totally if they have given 1000 crore, 100 crore has not yet come back. Out of that RBI, based on how much time has elapsed since it became NPA, has prescribed 20% as provisioning. That means maybe 20 crore is kept as provisioning. So gross NPA is 100 crore minus provisioning is 20 crore. So 80 crore is net NPA. What does it show us? If this entire 100 crore does not come back, we have enough money to pay 20 crores, but we don't have enough money to pay this 80 crore money back to depositors, because we already kept provisioning for that 20 crore. For this 80 we don't have it. That is what net NPA shows. This is the actual risk where we cannot pay back to the depositors. You understood this? So this is the meaning of net NPA. So this question was also asked, a loan becomes NPA when the interest or principal becomes overdue for a period of how many days? 90 days. So it's a simple question. Which of the following statements are correct regarding monetary transmission? So here, monetary transmission I think we have not yet discussed. First we'll discuss this and look at it. Monetary transmission means RBI when it changes interest rates, repo rate, reverse repo, whatever it is, banks should also change that interest rate. This is called monetary transmission. When RBI increases interest rate, banks should increase. When RBI reduces interest, banks should also reduce. This is what we call as monetary transmission. If monetary transmission is bad, it means that they are not doing it properly. Usually banks will do, whenever RBI increases interest rate, banks will immediately increase interest rates, because if they charge higher interest rate for the deposit, for the loans, will they earn more interest, more profit or not? Usually they will earn more profits. Because of this reason, they will immediately increase their interest rate. But when RBI reduces interest rate, if they reduce interest rate, then probably they will earn less profit, and that means they will not reduce interest rate. You understood? One way it is happening quickly on the same day probably. On the other way it is not happening at all, it is very slow. It took 3 months at once, you can say at one point by the time they actually reduced this interest rate, whatever RBI reduced. Imagine you are driving a car and if you turn left it is turning immediately, if you turn right it is not turning. Then there is a problem in the car. And same thing here in this entire mechanism, there is a problem. RBI felt we have to correct this, we have to do some sort of repair with regard to monetary transmission. Why banks are not passing on rate cut? You will see instead of monetary transmission sometimes they will use this phrase. Banks are not passing on the rate cut. RBI has cut the rates, but banks are not passing this benefit to customers. That means they are not cutting the interest rates. This is what we call as monetary transmission problem in India. Why are they doing it? Because NPAs have increased? Yeah. So because NPAs have increased, if NPAs have increased, they are making losses on one point. So wherever it is possible for them to make profits, they should be able to do it. So that is what they are trying to do, and this is leading to, you can say, transmission problem. First thing. Second, competition from small savings. Small savings means this National Savings Certificate, Kisan Vikas Patra, these type of things have been released by government directly. Earlier, if you remember, we saw how this whole thing works. Consider, for example, if government wants to take loan, we saw that government asks RBI to bring this loan. RBI will sell what? Government securities and bring that cash and it will give to government. Who will buy usually these government securities? Banks, and banks will have whose money? Most people who don't need the money, extra money, they will keep save in the bank. Savings means people don't need that money right now. That means upper middle class population and rich people will buy government securities. Because government security interest rate will be high or low. Giving loan to government, is it high risk or low risk? Low risk, because government is not going to run away anywhere. If risk is low, what happens to returns? Returns will also be low. That means the interest rate given by government is low. Even if it is low, people, if they are giving loan to government, they are rich people or poor people? Rich. Because for them what is important is safety. Somebody who has 10,000 crores money is not thinking about making it 10,100 crores. He is only thinking about how to make sure my 10,000 will remain as 10,000. That means he will give loan to government where it will be safe. You understood? Most people who are giving loans to government are rich people. Their loans are taken by government and spent on the economy. But when the time comes they have to pay back this loan, then what is the major source of income for government? Tax. It will tax everyone. When it taxes everyone, rich are only 1%. Remaining 99% will pay the tax also. And this money will go to the rich people. That the money actually wealth transfer is happening from poor to rich. Government felt that this is not a good situation to be in. If government has promised we'll have equity, we'll treat poor people better, then that means this sort of situation should not continue. At least we should reduce it. So government came up with a solution which is called as small savings instruments, where they said, see, you also keep giving loans, I will also directly take loans from poor directly. And this is small savings instrument. When they take loans from poor and directly give interest to poor, then the money is not moving from poor to rich. You understood the logic here. So that is why they created small savings instruments. And so these small savings instruments are all these. You can see Kisan Vikas Patra means for farmers welfare, they will release bonds, and these bonds are bought by farmers and others also. Maybe there will be some income criteria, all these type of things. Only those people can buy them. Once they buy them, they will go to government. Government, because they are poor, they felt government has to do something extra for them, and government started giving more interest to them. Government is giving 8% interest, 7.5% interest. Imagine government is giving 8% interest. A poor person is present. Will he deposit the money in the bank where bank is giving 4%, or will he give it to government where it is giving 8%? That means all the people in the country are attracted towards small savings. What happens to deposits in the bank? If deposits reduce, what happens to the bank ability to make profits? That will also reduce. This is what we call as competition from small savings instruments. Competition for what? For deposits, because deposits are reducing as they are all going towards government's small savings schemes. You understood this? So I'll try to summarize this. Government is now directly taking loans from poorer sections of society by issuing bonds. These bonds are called as small savings instruments in the name of different schemes. So they will issue the bond and take the loan, and the interest rate they are giving to them is poor is high, because government feels we have to do something extra to the poor. Because they are giving higher interest rate, people are not depositing enough money in the banks. That means as deposits reduce in the banks, this is creating problems for the bank. It is not able to earn enough profit, and because it is not able to earn enough profit, it is not passing on the rate cut to people whenever RBI reduces interest rate. You understood this? So now look at this question. Which of the following statements are correct regarding monetary transmission? It refers to process by which central bank's monetary policy decisions are passed on to financial market. Financial market means what? Where there is demand, supply is a market. That means vegetable market means vegetables are demanded, vegetables are supplied. Financial market means money is demanded, money is supplied. It is a bank or NBFC or whoever does it. Money lenders are also part of this financial market. That means is it true or false? True. Same thing, if you don't understand a term, come from backwards. Market means buying, selling is happening. Finance means money. So think of it like this, and you get some clarity here. Then this part, if it is true, which one can you eliminate? So rising NPAs and higher returns on small savings schemes may hinder effective monetary transmission. Imagine rising NPAs part you already know. Imagine you don't know about the second part, because and is given here. Both should be true to become true or not. Imagine or is given here, then what? If or is given here, only one part of this should become true. If and is given here, both this part should become true. You understood? Imagine you don't know this part, then you cannot be sure that this is true. Then come to third part. Lowering of CRR SLR requirements may help ensure effective monetary transmission. If we reduce CRR SLR, what happens to money in the bank? As money in every bank increases, what happens to supply of loans? As supply of loans increase, what happens to interest rates? It will decrease. That means when RBI rate cut happens, banks will also cut their rates. This is true or false? If 3 is true, which one can you eliminate? 3 has to be true. So even if you don't know the second part, you can still answer this question. But because you know it, you can answer it quicker. In sometimes, only when you know it, you can answer. So here there is one thing I'll try to tell you. Sometimes they will ask a question on a very simple topic. In fact, you would have studied this topic for 10 hours, 20 hours only. And they would have structured this question in such a way you cannot eliminate even a single option. But if you don't eliminate any option, then you should not answer that question even though it is on a known topic. That is a trap set by UPSC. If you feel, my ego is hurt because I have studied 20 hours and still I am not able to answer this question, then you will get negative marks in that question. In some other topic, you only know one point and you can still eliminate 3 options easily. If you don't read that question at all, you will not be able to score that mark. You understood this? They have deliberately created it like this. You have to make sure you read every question. If you feel that I know this topic very well but I cannot answer this question, then leave it. If you feel I don't know this topic but I still am able to answer this question, this type of questions will also be there in exam. You understood this? So, this is monetary transmission. Now coming to what we have done with regard to monetary transmission. We used to have BPLR until 2010. BPLR means benchmark prime lending rate. To understand this, you need to understand 2 concepts. One is corporate governance structure of the bank. Every company in India under Companies Act 2013, earlier we used to have 1956. Every company acts in a similar manner. There are shareholders, there is board of directors, there is CEO. Shareholders will elect this board of directors. Board of directors can choose the management including CEO. Just like citizens elect Lok Sabha will select prime minister or something, election will happen, indirect election. Same exact similar type of governance structure is present in every company. And bank is also a profit making company or not? Yes. Their business is banking but it is also a company. Now, imagine how do they set interest rates? Banks have freedom to set interest rates, but the board has to approve on some things. For example, right now, law has to be made on some things, then only executive can do it. Legislature has powers to make some law, some decisions can only be taken by legislature. So similarly, some decisions can only be taken by the board here. So, one such decision is, what will be the minimum level of interest given to anyone in the bank? So far we have already seen risk and returns, how are they related? If you want to take bigger risks, then you will feel I should at least get bigger returns, then only I will be willing to take bigger risks. From this bank's perspective, what is a bigger risk? Bank's business is giving loan. When is it a risky loan? Without collateral is correct. Then if they are giving to someone who we don't know whether this person will be able to pay back or not, then it is a risky loan. Imagine the person has no stable employment, or the person has just come out of jail, or the person has no other, you can say collateral, nothing. That means in all these cases it is a risky loan or not. So that means loans that the bank is giving, they are classified according to high risk, medium risk, low risk. Low risk loan, imagine someday somebody, Narayan Murthy comes to the bank, he says I want a loan. His net worth is north of 50,000 crores, so he is asking for 1,000 crore loan. Bank will feel, worst case scenario, he has still lot of more money. That means it is high risk or low risk? It is low risk. Imagine farmer comes and asks for 10 lakh loan. The person only has land and nothing else. It is high risk because first of all, agriculture is a high risk occupation. This person does not have other assets. That means its loan is, when it is high risk, bank will expect higher returns or not. That means loans for farmers are given at maybe 7%. Loans, imagine 8%. Loans for this, ideally Narayan Murthy should get loan at maybe 6% or something because it is low risk. You understood this? This is how banks operate because it is a business, this is how it is working. But it is, this is also fine. But sometimes what happens even further is, bank has decided that the minimum interest rate that we give to anybody is 6%. Who will decide it? The board will actually decide it. And the board every year, once it will decide, this year we will give for our best customer. Best means whoever is the least risk type of customer, for that person we will give the lowest interest rate, that will be called as BPLR. BPLR means benchmark prime lending rate. Once they have decided that, everything else will be slightly higher than that depending upon extra how much risk is present in that loan. Everybody is clear so far? But sometimes in this BPLR, the CEO or somebody in the management, CFO, somebody are higher up in the management, they have exceptional powers even to override the, you can say, decision of the board and give lower interest to someone in that particular case if they feel it is good for the bank. You understood? That means somebody like CEO, even though board has decided minimum interest rate that should be given to Narayan Murthy like person should be 6%, CEO can decide to give it at 5%. With his signature, he can say I am overruling the board decision and I will give at 5%. If the loan for 1000 crores is given at 5%, will the bank make a loss there or not? Imagine Narayan Murthy has promised, I will ask all my friends to open accounts in your bank. They will all put 1000 crores. That means the benefit that in future they will get maybe more, but right now they are going to make a loss. How will they recover their loss? They have to increase interest rate to someone else. Who will that be? That is this farmer who is already paying 8%. It will become 8.5%. You understand? Is it unfair for the farmer or not? First of all, he is paying more. Now he has to pay even more because the bank decided to give extra discount for rich people. So RBI felt that this BPLR is not a good idea because it is leading to too much of difference between, some difference will always be there, that is how economy works. But this much of difference should not be there between poor and rich. You understood? So that is the meaning of BPLR. We shifted away from BPLR because of this problem. Now if you read it, you will understand. BPLR was the rate at which commercial banks charge their customers who are most credit worthy. Credit worthy means least risk type of customers. So banks can fix BPLR with the approval of the board. So board decides every year what should be the BPLR. Under BPLR, banks could lend even below BPLR. That means there were exceptional situations where management could decide that below BPLR also we can lend. Ultimately, one borrower getting cheaper loan than the other was a major problem. Hence, base rate was introduced. So we shifted away from this BPLR to base rate. What exactly is base rate? In base rate, RBI gave a formula. They said, see, based on this formula, you calculate what will be your minimum interest rate. Below this rate, you should not lend to anybody. No exceptions allowed at all. So in this case, base rate is the interest rate below which scheduled commercial banks will lend no loans to its customer. This is a definition clearly given for base rate. Ultimate objective of base rate is to avoid that lower interest rate given. So base rate definition is defined based on no loans will be given below base rate. So how will they decide? Cost of funds. Cost of funds means what? You can try this now. Funds means what? Where will the bank get funds? From depositors. Cost for the funds means what? Interest given to depositor. That means how much is this person getting? That 4% is the cost for the funds. This is not the only way the bank can get money. It can get from other banks. That will be interest rate. It can get under repo rate also. So that means interest rate given for depositors plus loans taken, that is called cost of funds. Let us assume for simplicity it is 4%. Then operating expense means what? Salaries, branch expansion, this is operating expenses. Imagine that is 1% for simplicity. Minimum rate of return. The bank board has decided, see, if we don't earn 2% profit on the bank, then there is no use of running the bank. So that means every loan they have to earn at least minimum 2%. Then cost for CRR. Earlier, if you remember, I told you for 4% CRR, will RBI pay any money? No. That means for the remaining 96% loans, they have to increase that 0.1%. Let us assume it is 0.1. 4 plus 1 is 5 and 7 and 7.1% is the base rate. And once base rate is decided to be 7.1%, no bank is allowed to lend below this 7.1%. This bank, no loan is allowed to lend. So that means each bank in its board, they will decide separately what is their base rate. It is not the same for every bank. Each bank will decide their base rate every year. That means some bank may decide for us 1.5% profit is enough. Another bank may decide we need 3% profit. That means they will decide how much profit they want to take, all these things, and then they will. So who is deciding interest rates of banks in India? Banks themselves are deciding. RBI is only deciding the interest rate at which it will give the loan to the banks. But otherwise, banks themselves are deciding their. So then how does it work? If banks themselves are, imagine for example in a tea shop, who decides the price of tea? The shopkeeper will decide it. Then why tea is not 2000 rupees? Why is it only 10 rupees? Because there are 20 other tea shops, everybody is selling it at lower price. Because of competition, they have to reduce the price. And that is what banks will do. Even though banks have freedom to set this interest rate, They will reduce it because there is competition from other banks. You understood this? So here they will decide, okay, minimum we have to earn at least this much profit. They have come down to 7.1%. This 7.1% is what they are giving. But RBI also created transparency rules. That means you have to publish how much profit you are taking at this entire formula in the website. When they started publishing, one bank is taking 3% profit, another bank 1.5%. Where do you think people will go to take a loan? Whichever bank is taking less profit, they will go there. So banks felt, see, people are seeing this and not coming to our bank. They wanted to do some manipulation in the formula. Even the bank is, if it is taking, you can say, more profit also, they started showing less profit. Imagine a bank is taking 2%, but it wants to show only 1. So they have to increase 1% somewhere. And they found cost of funds, it is possible to manipulate, because cost of funds means how much they are paying for depositors. But RBI has not said which cost of funds. Cost of funds in the year 2000 or 2010 or 2023, they are not mentioned. So they went in search of some historical data where cost of funds used to be 5%. And they made this 1%, they made this 5%, and finally it will still come down to same 7.1%. You understood? This sort of manipulation they were doing because people were choosing those banks which were showing less profit here. And then they realized, the RBI realized this sort of manipulation is happening, which is leading to poor consumer choice. And then they created an alternative for this, which we call as marginal cost of funds. The problem was mostly coming from cost of funds. They changed this cost of funds to marginal cost of funds. Marginal means extra unit. In economy, simply marginal means extra unit. Extra unit means if today an extra unit of funds, unit here for funds is rupee, extra rupee comes into the bank today, what will be the interest rate that you give for that rupee today is what you should enter here. You cannot write 2010's data in this formula. You understood? You understood why they changed the formula? Because this manipulation was already happening by banks. We wanted to avoid this manipulation. That is why they changed the formula to marginal cost of funds lending rate. Marginal, this word you already would have seen. Diminishing marginal utility is there in NCERT book. Anybody knows what is diminishing marginal utility? So here look at the same logic. Utility means satisfaction or happiness. Marginal means next unit. Diminishing means every next unit of product you buy, your satisfaction that you derive out of that product will keep. Your first car will give you a lot of happiness. Second car that you buy, not so much. Third car, even less. First mango that you eat will give huge happiness. Second less, and third less, and fourth less, and 10th mango will give diarrhea but no happiness by then. So that means you can see as you consume more and more, you get less and less out of it. This is called as diminishing marginal utility. Similarly, in NCERT book, one more place is disguised unemployment. Marginal utility of labor is 0. That means every extra unit of extra person that is added into this work, their marginal productivity of labor is 0. Their productivity is 0. They are not adding extra value. How do you understand this disguised unemployment? Imagine in a field there are 8 people working. In a household there were 8 people, all of them working in the field, 4 acres or something. Actually 4 people were enough to produce whatever they are producing, 10 tons of wheat. But now 8 people are working. The remaining 4 people, extra people who are there here, are they adding any value here? No. That means marginal productivity. After 4th person, the extra person, 5th person who was added into this field, productivity of labor is 0. He is not adding any extra productivity in the field. This is what we call as disguised unemployment. Why is it called disguised? Because they don't know that they are unemployed. If you go and ask him, he will say, I am employed. But he is not adding any value. You understood? Disguised means we don't know, it is not clear that they are unemployed. So if you remove them from this field also, it will not reduce productivity, then it is called as disguised unemployment. Everybody understood what is marginal productivity of labor. Now you understand what is marginal. Marginal means extra unit. So we just replaced this formula in the base rate to, you can say, cost of funds to marginal cost of funds. Marginal means only the extra funds or new funds that are coming in today, and those interest rates are taken. So we change the formula to calculate interest rate of banks. So that means, what is the formula right now? Marginal cost of funds. Imagine today's interest rate can only be taken. Earlier interest rate cannot, this now is fixed because there is no possibility of manipulation. Then cost of holding CRR still 0.1, operating cost still 1%. They said, see, you don't have to show, anyway people are all manipulating how much profit they are taking, everybody is showing same, 1% or something. They felt no need to show that profit at all. Let this, whatever MCLR be there, MCLR plus X percent, whatever you are charging, that we will consider it automatically like extra profit, whatever you are taking. Because there is no use of, as per RBI, there was no use of showing profit as separate item in the margin means profit. So here some students get confused. Minimum margin means, margin is profit, marginal means extra unit, both are not same. Margin, wherever, imagine you go to buy some clothes or something, they will say margin is less, we cannot negotiate or something. Margin means profit. Marginal is a different term in economics which means extra unit. You understood this? So here margin, whatever was there, that means the profit, that was removed from this formula. But one more thing was added, tenor premium. That means tenure of the loan. Tenure means what? Duration of the loan. Which one is more risky, short-term loan or long-term loan? Why long-term loan is more risky?
So chances of default are higher.
Chance of, why is it higher? Okay, we won't know about the financial situation of the person. Why?
So it is easier to predict in the short term how the...
So prediction is easy in short term. How the world will look like tomorrow, it is not very difficult. Even Google can predict what will be the weather or something. Imagine 20 years later, if I ask weather on January 1st, 2040, then it will not be able to do it because there are there is too much complexity. Imagine we will not be able to say, we will not be able to predict business conditions 10 years later, 20 years later. Imagine they will take a huge loan, they will build big highway, and 20 years later, it will take 20 years to build it, just for assumption. By the end of this highway, already there are drones which are carrying people from place to place, nobody is using this highway. Then what happens to the loan that has been given? Will they be able to pay it back? No. Drones are already carrying, Amazon is already using 25 kg worth of materials they are carrying through drones. It is going to take only 5 years from here, probably 100 kg person can be carried from one location to another. That means you can see that technology is moving very quickly and banks or nobody else even can predict what the world will look like in 10 years. So that means the more farther in the future we go, the less our ability to predict it is, and that means the more risk there is. That means you can see that the bigger, longer term the loans are, you can say, the more interest rate will be. Tenor premium means for every 1 year, let us for simplicity take, every year we will add 0.1%. If you take a 10-year loan, 1% is added, 20-year loan, 2% is added to the interest. So this is how they added this part extra, but remaining everything is same. Margin was not calculated in the formula, but separately. So housing loan, they will say MCLR plus 3%. Car loan, MCLR plus 5%. So some other personal loan, MCLR plus 6-7%. So this way you can decide. Every bank is saying MCLR plus 6% is, you can say 5%. So depending upon, you can say how much you are paying to that bank, you can choose which bank you want to go to. Because marginal cost of funds is now fixed, you can say manipulation possibility has reduced. But in India, after 2008 financial crisis, NPAs had increased, and every subsequent crisis, too many crises have happened so far. 2008 and in 2012 there was PIGS crisis. Portugal, Italy, Greece and Spain, there was crisis. And after that we had some other, in India we had GST demonetization implementation, that also created problems. Then COVID, then trade war with the USA, etc. All these problems created NPAs in banks, and banks were in a desperate situation. Even after MCLR was introduced, still they started doing some manipulation in operating cost also. That means they just inflated the operating cost and showed that we are spending 2% instead of spending 1%. They convinced people that if you go to SBI you will get frustrated, but if you go to ICICI Bank we are spending more on operating costs, so we will take care of you better. They may not be spending that much, but they were showing on their websites that we are spending more on operating cost. You understood? Then RBI got, you can say, frustrated with this whole manipulation that was happening, and it felt that we have to change this whole thing. It is not working out anymore because somehow they are all manipulating somewhere, and we moved away from this MCLR. MCLR had initially created good outcomes, better monetary transmission, because now when RBI cuts the rates, you can say banks will also cut the rates, because today's rate whatever they are giving, that will only be, today's repo rate whatever they are giving, that is also cost of funds. When RBI cuts repo rate, today's repo rate will reduce, cost of funds immediately will reduce, and that means interest rate whatever they are giving will also reduce. So less discretion for banks in deciding interest rates, lower interest rate for borrowers. This was the advantage. But disadvantage was still manipulation was happening. So RBI came up with a solution that there should not be any discretion to the bank at all. That means bank should not decide how much interest you can say, how to decide this MCLR or whatever it is. It will be outside now. Instead of internal benchmark, let us keep outside external benchmark. External benchmark lending rate EBLR is, you can say, the new method we are using currently. We moved away from all internal benchmarks. What are internal benchmarks? Anything set by the board is internal benchmark. That means BPLR, base rate, MCLR, all of them are internal benchmarks because they are set by the board. Right now external benchmark means RBI itself will set it, or some other one more benchmarking corporation is there, they may set in future. That means it is set outside the bank. That is why it is called external benchmark. Right now RBI, you can say, is setting repo rate, that itself is being used by banks as benchmark. So there is still a chance banks will not cut lending rates even in BPLR, MCLR, that's what we saw. So we came up with this external benchmark. As of now 4 external benchmarks have been identified: repo rate, 91-day treasury bill yield, 182-day treasury bill yield, and anything else that this corporation can create as a benchmark. Most of the banks are as of now using repo rate. So how will they advertise their interest rates? Housing loan, repo plus 3%, personal loan, repo plus 8%. So that means there is no choice here anymore. Repo plus this much, our bank has no, you can say, control. Who will control repo rate? RBI. Now imagine, the biggest advantage in this is actually for monetary transmission, because if today RBI changes repo rate, what happens to all the interest rates? Automatically they will change today itself. Banks, they have no choice in the matter at all, because every loan rate is linked to repo rate itself. You understood? This is the meaning of EBLR, that is external benchmark lending rate. EBLR is important for prelims because it is a recent measure, it is a change that has happened in current affairs type of question can be asked on EBLR. Here there is one more small concept about yield. Yield is, everybody knows what is a treasury bill. What is the meaning of a treasury bill? Treasury bill is actually like it's a government security, it is a loan taken by government, but it is less than 1 year tenure. Loan taken by government with less than 1 year tenure, they will issue a government security, that is what we call as treasury bill. When government sells this to a person, this is what we call as primary market, because it is the first time it is being sold directly from the agency to the person, government to the person. Then people will among themselves, they can buy and sell. This is called secondary market. Secondary market is similar to second hand market. When government sells this bond, it would have written something on the interest of the bond. That is called as interest rate of the bond. Whenever you see interest rate of the bond, they are talking about primary market. Whenever you see yield of the bond, they are not talking about primary market, they are talking about secondary market. Secondary market means, how will they decide the price of anything in second hand market? Imagine you bought a car for 10 lakh, 5 years later you are trying to sell it. How will you decide the price of it? It is dependent upon demand supply, it is dependent upon you and that person negotiating it, and demand and supply. Imagine you need the money badly because there is an emergency. You will sell that car, imagine a fair price for the car may be 4 lakh, 5 lakh of 10 lakh car, but you will still be willing to sell it at maybe 3.5 lakh also because you need the money urgently, or you understood. Imagine that person needs the car very urgently, then he may be willing to buy it at 6 lakh also even though fair price is 5 lakh. That means in secondary market everything is negotiated. There is no fixed price there. It depends upon demand supply negotiation between these people. You understood so far? Now understand what is yield. Imagine the bond says, the bond is 100 rupees, 10 rupees is interest for 10 years. After 5 years, this person tries to sell this bond. 10 years will, usually interest is paid at the end. Let us assume like this. Everybody understood so far? Bond value is 100. That means he has given 100 rupee loan to government. 10 years later, 110 rupees will be given by government to whoever holds the bond. 5 years later, what will be fair price for the bond? 105 rupees is fair price for the bond. That is fair price, but negotiated price may not always be that much. This person, if he needs money immediately, he will be able to sell it at 103 rupees also. Then how much will he make? Remaining, if he sells it at 103, remaining 7 rupees in the next 5 years, this person is making. Whatever in the secondary market the buyer makes is called as yield of the bond. He is making 7%. 7% is the yield of the bond. Imagine there is, you can say, huge amount of demand for bonds right now, and he is willing to buy it at 108 rupees. Then how much he will make in the next 5 years? Only 2 rupees. And that 2% is the yield of the bond. You understood? Yield is a secondary market concept. Interest rate is a primary market concept. And yield is how much this person will make in secondary market. you can say that is called as yield of the bond. Everybody is clear about what is yield. How is it different from interest rate? Interest rate is just fixed by government, but yield is negotiated. It depends upon demand and supply. So these can also be used as benchmarks. Right now most of the banks are using only one benchmark, that is repo rate. Everybody is clear so far? Any questions until here? Bank interest rates will be decided based on EBLR, that is repo rate plus 3%, repo rate plus 5%. It will make interest rates transparent. Borrower will also know, roughly they will know how much spread, because every bank is spending same repo rate plus how much extra. So they will not know exact profit margin, but roughly they can approximate how much you can say each bank is taking as profit, because repo rate plus X% is same for everybody. You understood? Repo rate is same for everybody, extra how much they are charging is the only difference. Look at this question. Consider the following statements about MCLR. MCLR refers to minimum interest rate of a bank below which bank can never lend. This is actually definition for which one? This is definition for base rate. So sometimes it will create a confusion, it may be true also. But you have to think about it like this: when you are answering MCQs, you will develop this intuition over a period of time, how this question has actually been set by the question paper setter. The definitions sometimes are jumbled together. That means they will just take the definition and put here this definition there. This is one type of setting of question. This is how people, if you want to profile the examiner, how a question paper setter is set, this is one type of way with which they set questions. You understood? If you solve enough MCQs, then you will start getting a sense of how this question probably has been set, and that will give you extra edge over, you can say, others, probably 3-4 extra questions you can answer. But that is a skill that you will develop only by solving enough MCQs. So it will not help you in every question. Wherever there is ambiguity, there it will help you identify how probably this question has been set, and based on that you will be able to answer the question. So here actually the definition given when base rate was introduced, this is actually the definition. MCLR is determined on the basis of marginal cost or incremental cost of arranging one more rupee to the borrower, prospective borrower. This is true or false? True. Extra 1 rupee if you want to arrange to the borrower, it has to come from depositor. What is the cost of it means how much interest you are paying to the depositor. So that is, this part is true. If second one is true, definitely which one can you eliminate? So A and D is eliminated. You already eliminated 50-50 option is there, and based on this, based on intuition, you can answer this question. You understand this? So this is you can say with regard to monetary transmission what we have done so far, and currently we have EBLR. EBLR is the method currently being used. One more aspect about this is, as of now, even though EBLR is present, it does not mean other things are not being used. Loans given 5 years ago, they were given under MCLR rate, and today also they are still deciding MCLR for all the old loans. And similarly base rate also still is being decided, and some very old loans, 20-year-old loans or something, even BPLR also is being decided. That means all of them are in existence, but new loans that are given right now, they are all given under EBLR only. You understood this? Coming to loan write-off and waive-off. Write-off, everybody knows what is write-off of a loan. Probably it will be there in news everywhere. Write-off means what? You don't have, imagine you have taken a loan, you don't have to pay back the loan. This is called a write-off. Then who will pay the loan? Whoever is writing it off. Government has promised write-off of the loan, then government will, imagine sometimes you might have seen CM will come on TV and speech, he will give thing. For farmers, if they have taken loan up to 3 lakh in the last 2 years, you don't have to pay back the loan. Government will pay back the loan. This is called as a write-off. That means the borrower need not pay back the loan. This is called as You understood write-off? Okay, correct. That is waive-off. Waive-off means the borrower need not pay back the loan. That is called waive-off. Waive-off, complete cancellation of a loan account. Usually government pays instead of the borrower. Whoever is actually paying, you can say that person is actually called as government waived off the loan. That means government is actually paying the loan to the bank instead of this person paying. That is called waive-off. Write-off is an accounting exercise only. It won't change anything in the real world. People will try, banks will try to still continue to try and recover the loan. But write-off means from assets and liabilities list will be there, balance sheet of a bank where assets and liabilities are present. from this assets column, they will remove this NPA. That is called as write-off. It doesn't mean that the bank will stop trying to recover it. The bank in its own estimation has reduced the probability of recovery and it has taken it out from its accounts. But continuous attempts will still keep happening to recover it. So far, once the loan has been written off, only 16% of those written off loans have been recovered, which means you can see the probability that recovery happens is very low. It does not mean they will stop attempting to recover it, but probability is low that they will be able to recover it. You understood this? This is basically difference between waive off and write off. Everybody understood what is waive off and write off? Then measures taken to resolve NPAs. This part is relatively simple. What exactly we are doing? Earlier I told you that once a loan becomes NPA, then this bank it has given this person a loan, he has kept some collateral. Imagine land documents. Bank has no authority to sell this land because who is the owner of the land is still this person. Bank has to go to court. Then court sometimes will take the side of this person also, and by the time it takes also it takes a lot of time. Court in India is very slow. One of the biggest problems in court in India is that it is slow. Justice delayed is justice denied, so people are not interested to go to court. In fact, there is a saying in India courts don't give punishment, court itself is punishment. That means if you go to court, it is going to take decades by the time it is resolved. So this is one problem. For economics cases, it is not going to work well. Yeah. So that means I am not saying it, maybe somebody else said it, so that I will not be held for contempt. So consider this. They went to court, but court took 6 to 8 years by the time they resolved this case. So we felt that maybe tribunals will help. If we set up tribunals only, they will take up only these cases. So we set up tribunals. And once we set them up, initially they were working well. But over a period of time, because of 2008 financial crisis and subsequent crisis, number of NPAs kept on increasing. And even tribunals were not able to handle this kind of scale. And this led to delays even in tribunals, they were also insufficient. If courts are taking 6 to 8 years, tribunals took, I think you can say, they were also taking 4 to 5 years, slightly lesser than courts only. So this created, you can say, more problems. We were not able to resolve these NPAs easily. So in 98, Narasimhan II committee recommended that we have to do something related to NPAs. We are unable to solve using existing mechanisms. So SARFAESI Act 2002 was enacted. What exactly is SARFAESI Act? So SARFAESI, what it does is, earlier we saw that you cannot actually go for auction of this collateral without a court order. SARFAESI removes this restriction only in some extraordinary cases where there is a threshold for this bank. If certain amount of NPAs are present in the bank, right now the threshold is around 25%. If a government wants, they can change the threshold, but imagine as of now it's 25. If the total NPAs of a bank are up to 25%, then the bank is about to fail. At this point, the requirement that they have to go to court and get a court permission to auction this collateral is removed. Then they can directly give a notice for 90 days, they will give time. You pay the loan within 90 days or we will go for auction of your collateral. This is basically SARFAESI Act. But 25% is extremely large, no bank will automatically get there. So they have given an option for them to buy the loans, buy NPAs from other banks. Imagine this is bank A, they will go to bank B, they will say, I will buy some NPAs from you so that my NPAs will become 25%. So that we can invoke SARFAESI Act. Will bank B be happy to sell this NPAs or not? They will be very happy because nobody is, you can say the person is not paying back, they can cut their losses, at least reduce their losses if they sell their NPA. So this is basically SARFAESI Act. SARFAESI Act means banks will try to buy some NPAs. If they are already 19%, 20% NPA, they will buy a little bit extra NPAs so that they will reach the threshold. Then once the SARFAESI Act is enacted, for all the loans including what they bought and all the earlier NPAs, they can, only in NPAs, they can directly go for auctioning of the collateral. And when they auction the collateral and sell it, then they will be able to recover the loans. You understood the meaning of SARFAESI Act. Securitization is, meaning of securitization is selling on buying of loans. Trading of loans is called as securitization. Reconstruction of financial asset. What has become NPA, we are reconstructing this asset. Reconstructing means making it profitable again. That is reconstruction of financial asset. Enforcement of security interest. Security interest means the document that a person will sign when he takes a loan, enforcing whatever he has agreed to, all the terms and conditions which will be written in small letters which you sign, they are enforcing that. That is called as SARFAESI Act. You understood? So, if more than 25% of bank loans are NPAs, no need to go to court or tribunal, they can send a notice to auction the collateral, they can buy the loans also to reach this 25% target. So, here you have to understand twin balance sheet syndrome. I think probably you would have heard of it. Balance sheets of banks, this balance sheet, assets and liabilities will be present, and balance sheets of corporates, both have gone bad, both are facing losses. This is what we call as twin balance sheet syndrome. Right now we are in this sort of a problem, we are trying to get out of it. Why this has happened? Assets of a bank means what? They have given a loan to the corporate. Corporates are facing losses because of COVID and before that lot of all these crises. Because they are facing losses, they are unable to pay back the loan. They are unable to pay back the loan and they are saying that, see, right now we are in a tight situation, you give me a new loan. And then using that we will try to do restructuring of the business, then we will make profits, then I will pay back new loan, old loan, everything. But banks are also not in a position to give loan because already their NPAs are high. Even their money, their own money is also kept under provisioning because all these high NPAs are there. So banks are saying, first you pay back the old loan, then we will give you the new loan. And right now they are in a sort of a deadlock because neither the banks are able to give new loans nor the corporates are paying back old loans. This is what we call as twin balance sheet syndrome. If no new loans are given to corporates and they are stuck and loans are not paid back to banks and they are also stuck and they are not giving much loans, what happens in the economy? What happens to production by these corporates? If production reduces, what happens to employment? Employment reduces, then what happens to demand? People are getting no salary. Then demand will also reduce and this creates a vicious cycle instead of virtuous cycle. We don't want a vicious cycle to be created, that means we have to resolve this twin balance sheet syndrome. You understood so far? To prevent in future to further worsening of this twin balance sheet syndrome, what we have done is we have tried to create a logical separation between banks and corporates. Logical separation means we have created some rules. Banks are not allowed to hold on to corporate shares. If corporate fails, then bank will also fail if they are if they are allowed to buy shares of corporates. You understood? So this sort of logical separation we have tried to create. Because of this type of rules, right now we have these rules. Banks are not allowed to hold corporate shares for more than 90 days. They cannot hold. Temporarily they can hold and sell or something, but extra rules, lot of rules have been created that they cannot hold shares. Because of this reason, in some countries what happens is loan has been given by a bank. Bank has given a loan to a company and this company is doing business but it made losses. Banks, what they used to do was, they used to convert this loan into shares. What does it mean when we say converting loan into shares? Imagine the company's net worth is 100 crore, the loan given is 60 crore. That means 60 crore loan already they have given. If both parties agree, the bank agrees and the company agrees, this company need not pay back the loan. Now suddenly who will become the 60% shareholder? Bank will become 60% shareholder of this company. If bank becomes 60% shareholder, they can appoint the board, change the person, change the management and maybe make sure this company will make profits. Worst case scenario, at least liquidate the company, sell all the assets and recover whatever is possible to recover. You understood? This is possible in other countries, but in India we have created this separation. It is not possible because they cannot hold shares. They are unable to convert this debt into equity. Everybody understood so far? Now, to solve this problem, in India we have allowed to create ARCs. ARC means Asset Reconstruction Company. Asset means loan, reconstruction means they will try to recover it. So what this ARC will do is it will do securitization first. Securitization means what? Buying and selling of loans. It will go to the bank, it will select an NPA, bunch of NPAs, it will buy these NPAs. Will the bank be happy to sell NPAs or not? Yes. And this ARC, it will not just buy NPAs at face value. Imagine NPA is 100 crore worth. Then they will do hard negotiation. I want this loan at 50 crores. Because for the bank anyway it is a loss. At least 50 crore is better than nothing. Bank will say 70 crores. Finally they may agree for 60 crores. At 60 crores the bank will sell it to ARC. ARC, if it is capable of recovering it, it will get an entire 100 crores. It makes a profit. Worst case scenario, it will lose entire 60 crores. Maybe they will be able to recover 20 crores or something by doing liquidation or something. You understood? This is the business of ARC. When a bank sells it at a loss, that means face value is 100 crore, bank is selling it at 60 crore. How much is the loss here? 40 crore is the loss. This 40 crore loss is also called as discount or also called as haircut. Loans are sold at a haircut, means bank has taken a loss and sold the loan at a lower cost. You understood? In newspaper you might have seen the word haircut here and there. It is very simple. If a bank sells a loan at a lower cost than its original face value, whatever it has lost, that part of money that it has lost is called as discount or haircut. You understood this? So IRC will buy it at a haircut. First thing, advantage for ARC is it is buying at a haircut. Second thing, ARC's business is only one. It is not giving any loans. It is only trying to recover loans. So it will become expert in only recovering loans over a period of time, and it will use different tactics, methods, whatever is possible to recover loans, and it will recover loans. Worst case scenario, if it is not able to recover loans, ARC, as the name suggests, is it a bank or is it a company? It is a company. There is no restriction on one company holding shares of another company. That means ARC will be able to convert this debt into equity, and that means it will take over the control of this company and it will change the management or whatever it wants to do with the company it can do. You understood? This is another solution that we have created, ARCs. ARCs are asset reconstruction companies. Loans sold to these companies and then converted to equity. First they will try to recover it if possible. Only if it is not possible, then they will convert it into equity. Banks cannot hold equity beyond a point because it creates more risk in the economy. Risk of what? If banks hold equity of corporates, what risk will increase? Risk of this twin balance sheet syndrome further worsening will increase. You understood? That is why we created this asset reconstruction companies, ARCs. Everybody understood what is this? ARC. ARC, one of the news is there in 2023. This is important for current affairs. Sudarshan Sen committee has created new regulatory framework for ARCs. So they have said if you have to set up an ARC, minimum net owned fund of 1000 crore is, you can say, necessary to act as resolution applicants. Okay, this is actually minimum net owned fund of 1000 crore is 1, and they can be acting as applicants also. Second point, applicants under IBC. Anybody knows what is IBC? Insolvency Bankruptcy Code. Net owned fund means if you want to set up an ARC yourself, your own fund should be first 1000 crores. Then above that, if you want, you can take from outside equity by selling shares. That is net owned fund. Then second, IBC is Insolvency Bankruptcy Code. Earlier, it is, you can say, ARCs were not given permission to start a case in you can say IBC. Only banks could do it, ARCs could not do it. Now we have given power for this, you can say, ARCs also to directly go to IBC to recover this loan. IBC is mostly mains concept, but if you can go through it once, it is simple, there is nothing complex. Once you go to IBC, either they will create a resolution plan. The company, if it is making losses, they will try to bring it to profits. If they feel they cannot bring it to profits, then they will go for liquidation. Liquidation means what? You already know what is liquidity. Liquidity means cash. Liquidation means converting into cash. That means you convert a company into cash. How to convert a company into cash? You try to sell the entire company. If nobody is buying, then we auction all the assets. Imagine how we convert any company, Kingfisher Airlines, into cash. We'll auction their Boeing 747s, aeroplanes, their land, their buildings, their laptops and chairs and staplers and pins and laptops, everything. That means auctioning will happen like this. And finally, whatever they get, the entire money, this is distributed among who should get the money first. There is a clear criteria and clear list of who should get the money first in IBC, in the Act itself. First, the money will be given to workers who are working in this Kingfisher Airlines. After that, that is over. Still, if money is remaining, then creditors who have given loans to Kingfisher Airlines. After that, if money is remaining, then high-level employees, management employees will get it. And then, so this way, there is a clear criteria. Finally, if still money is remaining, shareholders will get whatever money is divided among them. You understood? This is called liquidation of a company. And right now, earlier ARC could not go for liquidation by itself, only by converting it into equity. If it wants to do it by itself, then right now it is advantageous because there is a clear time limit in IBC. Within 330 days, if nothing happens, we can directly get into liquidation process itself. So this will speed up the process of closing companies and benefit these ARCs, you can say, by allowing them to become applicants under IBC. Everybody understood how IBC is working?
Sir,
Yeah.
For ARC to go into the process of liquidation, it has to first become the applicant of IBC, right? It cannot automatically start auctioning without going to the IBC.
Without going to IBC, there is one more option. It can convert the loan into equity. If it converts into equity, then it will become owner. Then it can go to IBC as owner, not as person who has given credit. To IBC both can go, whoever has taken loan, whoever has given loan. So this is the only two options. So raised minimum capital requirement at setting up of an ARC to 300 crore. That means if as of now minimum capital requirement means first how much capital is required to set up an ARC. This has earlier it used to be 100 crore, now you can say it has been increased to 300 crore. Net owned capital is, you can say minimum net owned fund. Fund means how much money it has to buy this NPAs, that is fund. Capital means, you can say, we saw earlier capital means for expansion of business and such other things, that is capital. Changes in corporate governance norms like constituting audit committee with only non-executive directors. This will also act like a company. Company means we already saw corporate governance norms in the company. There will be board of directors. Among this board of directors, they are responsible for doing audit of the company. Some directors can be chosen for doing audit. This is a governance related reform so that ARCs will function in a much better manner compared to earlier. So this is regulatory framework for ARCs. In its, you can say, in this important point is for prelims is only one. Earlier, they were not able to go to IBC by themselves. Now it is possible for to go to IBC. Sudarshan Sen committees for ARC's regulatory framework. This type of a statement can also be given in prelims. So in 2015 we did one more reform, that is Mission Indradhanush. Mission Indradhanush because 7 you can say reforms were there for improving PSB's governance. 7 reforms are in ABCDEFG form. They created some acronym as ABCDEFG. That is, here it is not in order. A, B, C is capitalization, D is de-stressing. So appointment means in this there is CEO and board of director used to be, you can say, head of board of director and CEO position used to be same. This created problems in governance. What is the role of the board here? Role of the board is actually asking questions to CEO. But this was not happening. So because both persons were same, they were controlling the board, they were controlling the entire company. Now we have separated this function of CEO and this managing director. So that is appointments. Then Bank Boards Bureau was created. Now it is replaced by FSIB. As the name suggests, Bank Boards Bureau means its responsibility was to appoint the board of the bank. Board means this. Usually who will appoint the board is actually shareholders. But in public sector bank, who is the shareholder? Government. Because government is the owner and shareholder. Government, if it appoints board members, usually they were all political members. They knew nothing about the bank. It was, you can say, leading to poor governance of the bank. To address this problem, now they have created a Bank Boards Bureau which has now become this FSIB. This FSIB is now responsible to appoint the board members. Who will appoint this FSIB is still government only. Actually earlier BBB was there. BBB's responsibility that was given in law is to appoint board members of banks and give suggestions to bank. But then BBB started appointing members of insurance companies boards also. Then somebody went to court saying BBB does not have power to do this. Then court found that it is true that they don't have power to do this and cancelled the appointments made by BBB to insurance companies. So government felt we have to address this problem and they replaced this BBB with FSIB, giving explicit powers to appoint board members of insurance companies also along with banks. That is why this replacement of BBB has happened with this FSIB. Otherwise everything else is same. Only that extra powers of FSIB is they can appoint not just board members of banks, they can appoint board members of insurance companies also. You understood? Then capitalization. Capital, everybody knows what is capital. It is investment. Capitalization means adding extra investment into the bank is capitalization. Why extra investment is required? If NPAs increase, where will we get the money to give back depositors? It should come from capital. In public sector banks, who is the shareholder? Government. Who should give the capital is government. So that means government has promised that we will give 1.8 lakh crore. Out of that around 70,000 or something they have already given. But after that, they found it difficult to give because of COVID and such. Now they are trying to give a little bit extra money to, you can say, capital of the bank. De-stressing means taking measures to reduce the stress in the banks. One measure which we just discussed is, you can say, banks should not own the equity of companies. This type of rules and regulations are created so that overall risk in the banking system can reduce. Even prompt corrective action, which we will discuss, these are examples of de-stressing measures. And usually whenever bank was employing people or removing people, government used to interfere, because if it removes people, people will not vote for government. This political interference was happening. Now they have promised that will not interfere into hiring and firing decisions of the bank. Framework for accountability. KPIs will be created. KPI means key performance indicator. Whether the bank is performing well or not, based on how much NPAs are there, how much profits it is making, etc. If profits increase, they will link the incentives of higher management. CEO, CFO of bank will get double salary if profits of the bank increase, NPAs decrease, etc. This way they have linked the performance of the bank to incentives of higher management. This is called as framework for accountability. Finally, whatever else PJ Naik said, actually all of these are PJ Naik recommendations. Whatever else he said are governance reforms. Just to put it into ABCD, EFG, they just created this, and remaining they put into a G, that is governance reform. He also recommended a bank investment company. What would be bank investment company? It is a holding company. Holding means one company, bank investment company, will hold all the other public sector banks. Government will own this bank investment company. Right now government is directly owning these public sector banks. From here we want to shift to a situation where bank investment company will own all the public sector banks and government will only own this bank investment. Extra layer of, you can say, protection against politicization. Doesn't mean it will not happen, but it will reduce. This is, you can say, PJ Naik's recommendation. You understood? So, next part is this project Sashakt. Will take 10 minutes until this project Sashakt is done. Everybody is fine. So, in project Sashakt, we saw earlier we have already seen what banks are doing using tribunals, using courts, using SARFAESI Act, etc. Up to 50, usually you can say what is presently being used for solving NPAs is this project Sashakt. Sunil Mehta panel actually recommended this project Sashakt. What Sunil Mehta panel has done is he has divided this loans into 3 parts, how to deal with this NPAs. First is based on size of the NPA. Size means how much loan has been given basically as NPA. So first is up to 50 crore loan size, loan ticket size. Up to 50 crore bank is capable of solving by itself using its own recovery mechanisms, recovery agents, teams, using courts, using tribunals, SARFAESI Act, etc. That is up to 50 crore. Between 50 to 500 crore, they will use IBC. IBC means Insolvency Bankruptcy Code. They will try to go for a resolution plan. If it does not work, then they will go for liquidation of the company. If there is a dispute, then they will go for National Company Law Tribunal, which is a tribunal which will resolve disputes. If it is a person who has taken a loan, then the dispute is resolved by Debt Recovery Tribunal itself. If it is a company which has taken a loan and dispute is there, then it will go to company, in the name itself it is there, Company Law Tribunal. So this is 50 to 500 crore. For above 500 crore, there is a slightly complex mechanism that has been created by this project Sashakt, and that is this AMC and AIF combined. So this AMC means it acts like a mutual fund. Anybody knows how mutual fund works? Mutual fund means there are people who don't know much about stock market, but they want to invest there. So what they will do is they will pool together money and they will give it to mutual fund. Mutual fund will hire some experts who know about stock market. They will invest in the stock market. If they make profits, they will take a share out of the profit. If you make losses, they will not get anything. That means they are trying to invest your money, pooled money. Pooled means it is being taken from many people. This is how asset management company is working. So asset management company will pool the money together, it will invest somewhere. And asset management company can create different funds. These are all called alternative investment funds. Depending upon how much risk you want to take, they will all be, you can say, different type of funds. Imagine you want to take more risk, then you can invest in one AIF. If you want to take less risk, you can invest in other AIF. Right now the problem is what exactly is the problem is, big NPAs like 500 crore plus, ARCs do not have enough money to be able to buy that NPA. To buy NPA first they need money or not. Then they will try to recover it. Because they don't have money, they are unable to buy these NPAs from the bank. So right now what we are trying to do is, AMC will bring lot of money from people who are investing. They will create different AIFs. People who are willing to take enough risk, that AIF's money will go into ARC. And using this money, ARC will buy NPAs from the bank. Once it buys, what will it do? It will try to recover that loan. If it cannot recover the loan, what will it do? It will convert it into equity or liquidate it or IBC or something. And finally, once it has done, then it will give the profit to this AMC. AMC will give it to whoever has invested. You understood? This is the last part. For loans above 500 crore, panel recommended an independent AMC. AMC means asset management company supported by institutional funding through AIF. AIF means this fund that this, you can say, AMC has created is AIF. You should know a bit about, you can say, what is AMC AIF. I have given here. You can go through this definition of AMC and AIF by yourself. Tomorrow I will just explain briefly what is AMC and AIF. So from this bad bank part we will discuss in next class.